Hello, everyone. Welcome. Thanks to the thousands of us that are joining online. We had close to 30,000 registrations here, so we got a packed house. We know how valuable your time is, and we appreciate you taking that time to join us today. My name is Michael McCrary. I'm a regional brokerage consultant for Fidelity Investments. We work with self-directed clients of Fidelity throughout the country, and we look to provide support around strategy and education with their investment decision, just trying to help them make more informed decisions. So I'm happy to be your host for today and our monthly special. Our first session is What Are the Charts Telling Us? That's going to be our 1 o'clock session. And then at 2 o'clock, we're going to step into a fundamental segment following the fundamentals. And finally, at 3 o'clock, we're going to bring it all together. We're going to talk about how you can manage a strategy using technicals and fundamental research, kind of using both of those approaches to analysis. So I hope you can join us for all these 3 sessions. If you are planning on staying for sessions 2 and 3, you can keep this page open. There's really no need to register for the other sessions separately. But before we get started, just a couple of quick housekeeping items for those viewing online. On the right-hand side, you can access the Q&A. So if you have questions that you wanted to pose to our host today, feel free to chime in and just ask the questions. And for those looking for a closed captioning, that is available. If you're watching online, just clicking at the bottom below the video screen, you'll be able to activate that. So now we're going to go ahead and just jump into our first session, and I'd like to introduce my colleague, John Gagliardi. Now, John, this is the first time I've had the honor to be part of the series with you, but I've been watching it from afar and really enjoyed your insights and that you provided, and I'm sure today's not going to be any different. We have a number of questions that are provided by our attendees in advance, so we're going to go through some of those here shortly, but before we get to them, John, what are the charts telling us?
The same thing they always tell us, right? They're telling us the truth. And the reason that we like charts so much, for those of you that knew the show, you've never heard me say this. For those of you who are fans and have seen the show multiple times, this is not new. The charts are what pay us, right? It doesn't matter what the economists say. It doesn't matter what my opinion is. It doesn't even matter what the fundamentals are. In the end, it's price that pays us. So we pay very close attention to price. And I do want to talk about the S&P a little bit to start things off. And I always tell everyone, when in doubt, zoom out. Look at your longest possible time frame, and that will tell you the ultimate picture of what's happening. And we could see the S&P is up and to the right. The S&P is up and to the right, despite the last 5 years have had some of the most horrific bad news markets could have possibly had, yet here we are at all-time highs. And that includes COVID, 2020, shutting down the world economy. Unemployment went to 15%. We hit 4,600. Now, I know the Fed opened up their balance sheet, and there's a lot to be said about that. We went from a $9 trillion balance sheet to 15. Hey, Mike, if you hand a bank $6 trillion, what do the banks turn it into? $60 trillion. And a lot of that found its way into markets, which created inflation. The Fed raised rates 10 times in the course of 16 months, giving us a 28% pullback. The economists all said, we're going to have a recession. Within 6 months, we had 2 negative quarters of GDP. Ding, ding, ding. When I went to school, that was a recession. And the economists said, no, no, no. You only have 3% unemployment. It's not a recession. So when? They said it's going to happen in 2023. Market went up 25%. Now they're saying 2024. Market's up 5%. I'm still waiting to find out. I think they're going to say 2025. What do you think, Mike? End of 2024, they'll say 25?
Yeah, it keeps kicking further and further, right?
Kick that can forever. Eventually, they'll get it right. But to be fair, the economists have said that none of these pullbacks were recessions. The recession you had 2011 wasn't a recession. It was a recession for stocks. 2016, 3 years of no growth in the stock market. Economists said no recession there. None in 2018. There was a 3-month recession for COVID. Wow. And nothing for 2022. So what do we know? We know that stocks are at all-time highs. We're in a secular long-term bull market. We've had recessions about every 5 years or so, COVID and all this being the exception, the last 2. But this is all normal market behavior. If we look back going back to the very beginning, markets don't always go up. We had a sideways market from 64 to 82. That was the silent generation in power. Not enough people to buy stocks. S&P was stuck at 100 for 19 years. From 1982 to 2000, we go up 1,550%. S&P 1550, and all you have to do is sit in the S&P. If you throw in the dividends and compound them, you're up closer to 3,000% in these 19 years. So what was this about? Why did this happen? And it's a change in generations. We go from the lost generation or the silent generation in the 60s and 70s to the baby boomers in 1982. And the boomers have about 20% more people. 20% more people buy 20% more stocks, more houses, more cars. And the innovation, you get Bill Gates and Steve Jobs. Enough said, right? And then we get Generation X, that's me, born in 1970, grandchild of the Great Depression. Market goes nowhere for 13 years. From 2013 to present, we've had the millennials. You can love them, you can hate them, you may be one. Millennials are the largest generation in world history. There's about 30% more millennials than there were Gen X. The market's already up 350% since 2013. And it's demand. It's demand despite a global pandemic. Despite the Fed raising rates 10 times, Fed policy has not changed, but markets are still going up. That is a remarkable thing to say in a sentence. Raising rates 10 times and markets are still going up. And no policy change yet. Talk of policy, a lot of chatter, but no change in policy yet. So Mike, what are some other markets people want to see? So we'll break it down. I'll go to my 5-year chart and we'll tear apart what's been going on lately.
Yeah, I think, let's hit the key ones. We looked at the S&P. Let's look at NASDAQ. Heavy technology there. What's shaping up there in NASDAQ?
So since I got this up, I'll just mention S&P. If you think that you missed the market, I don't know what you're talking about. We spent 2 of the last 5 years going sideways. We had our recession in stocks. We made back what we lost. We've only been going up since January, and the market's been kind enough to give you a nice 5% pullback here. But let's take a look at the Qs and see what that tells us. Now, the Qs are a similar story, but we all know technology has been leading. And I said has been because that might not be the case in the future, but nobody knows. And we can see very clearly that the first initial try of a breakout, it was trying to break out the end of the old year. It didn't wait for January. It started a little bit earlier. But by January, we had a nice little takeoff here in the NASDAQ. Now, if you notice the sell-off is a little bit deeper and been a little bit more harsh than what we saw in the S&P. So if you take the S&P 500 and said, I want a more concentrated portfolio, well, the NASDAQ will only give you 100 names. By design, they cannot own any banks or brokerage firms, so there's no financials. But the other 10 sectors are represented. Costco is in the top 10 of the NASDAQ 100. And what are the charts telling us? Yes, we broke out. We broke out a little earlier, but this sell-off is a bit more intense than what we're seeing in the S&P 500, which is saying we may, after many, many years, we might be looking at some sector rotation. Pure tech, XLK, is selling off pretty hard. And it did rally early. If we look at XLK, this was rallying in November. And that was the sign of the early leadership and what was going to lead the next rally. It was tech. And it's been tech really since 2017. Tech has really been dominating everything. I never bet against tech because I'm definitely not betting against it. But if we're rebalancing the portfolio, there may be room for some other sectors that are up and coming. Any other major markets?
Yeah, so before we get into sectors just too much further, I want to just take a step and look at Russell, right, on the small cap, because there's a lot of conversations around small caps being undervalued, and we'll get into the fundamental conversation in the next segment. But, what are the charts telling us in the small cap space?
So for that, I'll go to IWM, and here, I'll make my chart a little bit bigger. If we have the reason I love charts, and by the way, for those of you that don't know Mike McCrary, Mike is also a charted market technician. We both are. That means that we had to read like 36 books on charting. I think 23 at one point, but altogether, I think I read like 36. And we had to take 3 3-hour tests on this stuff. So we can tell you for a fact, this ain't going up. Up means up and to the right. It means higher highs and higher lows. I don't have any of that stuff. So what did we have? In 2021, we had a rally, we had an expansion, we had a peak, we had a recession, and we've been in a trough ever since. We tried to break out with this, everything was breaking out in January, tried in January, and it failed. We're right back down into trend, although it looks like we are getting an equal high from the last high, which is higher than the low. So you can argue maybe this is a pivot moment for small cap, but why force it? I've got stuff that is actually going up. We go to mid cap. Mid cap, MDY broke all-time highs, did a pullback. It's back in the range. It's retesting the old high that from 2021. It's retesting 2021. This looks better. The S&P looks better, leading the way. And of course, we just already discussed the NASDAQ. Yes, it looked better, but this sell-off looks a little bit suspect. We got to look at this a little carefully because this sell-off has been a little deeper than some of the others. Any other major markets, or you want to jump to sectors?
Let's jump into sectors for the time being. I think you touched on technology, and it looks like maybe there's a little bit of a pullback there, and we're seeing some strength in some other names, other areas. But what are the charts telling us as it pertains to sectors? Are we seeing that rotation? Is it kind of just a temporary rotation, or is it something that you feel has some legs and might be a little bit overextended?
Well, you know what's interesting, and by the way, I don't know if we have time to do that. Maybe I'll jump into this a little later, but Fidelity we're huge believers in the business cycle. And this is one thing that I think Fidelity has nailed that none of our competition talks about. Every 5 years, you will get a business cycle. You will get an expansion peak, recession trough. You sometimes hear about this talked about as the presidential cycle. Why do I care? And the reason you care, the sectors will go up and down in an order that tends to repeat itself. And Fidelity's been tracking this stuff since World War II. So the sectors that should lead the early phase of a new bull market and new highs after 2 years of no new highs means we're in the early phase of a new bull market on the charts. Let's see what the sectors are telling us. Now, the sectors that should lead, according to the roadmap on Fidelity.com, are financials. We just touched all-time highs and backed off a little bit. These are highs that we established in 2022. And if we go out a little further, we max out our chart, you'll notice financials didn't do anything for 17 years. Nothing, no growth. Up until 2021, we broke out to new highs. We retested. We took what used to be resistance at FLX at 30, became support, support, support. We took off. We're currently trading at $40 and change. So financials are looking good. If financials are looking good, consumer discretion should do good. XLY. By the way, if you have a hard time remembering all these ETFs, if you see the letters XL, you know that these are S&P names. So they're all in the S&P 500. The next letter will determine what sector they're in. And XLY, why is that consumer discretion? I ask my wife, why did you buy this? And I say, look, it's consumer discretion. She says, no, it's not. It's a consumer staple. And we'll argue about this silliness. But I use the letter Y to remember it's consumer discretion. This chart looks great, except we haven't posted new highs in a while. If I look at my 5-year chart, not looking so great. The major components of this are Amazon and Tesla. Amazon looks great, Tesla not so much, but we'll get to that. So we got financials, consumer discretion, and the other two that should lead the way are tech, XLK, and I think it's just easier for me to type it in than to look for it. We've got tech, all-time highs. That last sell-off is a little circumspect. And XLC, which is communication services. For those of you who are students of the game, S&P was becoming 50% technology, and they spun off technology into comm services. So it's Google, Facebook, video game makers, eBay, Netflix. Disney is in there because of their streaming service being a large portion of their revenue. So XLC is kind of a hodgepodge of all things tech that are really communication services. How do we talk to each other? It also has Verizon, AT&T in there. Now, this thing has been a beast. It's up 49% one-year returns, but that's because of the declines. Again, this is another sector that's dominated with two names, which is Facebook and Google, which I'm sure we'll get to. So the leaders are leading, and the next phase, if you believe in sector rotation, The three sectors that should do well are industrials, materials, and energy. Mike, what's your favorite in the bunch between basic materials, energy, and industrials? What do you like?
Energy's been looking decent, right?
Energy 3-month return is 19%. So in the last 3 months, this has been the best sector to be in for the last quarter, but not for the last 5 years.
Yeah.
It's been stuck. A lot of things have been stuck for all these years. Since 2022, we've had a sideways market, but very subtly, if you look at the lows, we keep catching higher lows on my weekly chart here. The last one was a shakeout, and then we ripped to new highs. By the way, this kind of market activity, not unusual. So if you're using the charts and you're using risk management, as you should, you might not use the current lows. You might use the prior lows or the lows before that to make sure you're not whipsawed out. Because sure enough, we broke a slightly lower low. It looked pretty negative. Then we completely ripped to all-time highs. And we're currently testing what used to be resistance, right? The theory of polarity. What used to be resistance becomes support. And that's exactly what XLE is doing right now. So what's your second favorite of the triplets? By the way, I call these the triplets: industrials, materials, and energy.
Let's go industrials.
Now, industrials are always the first ones out of the gate. So I think of this very simply. If we were building a Caterpillar truck, that means Caterpillar would be going up if we were building more trucks. If we're building more trucks, we're going to need more materials. If we need more materials, it's going to require a lot of energy to take a rubber tree plant, turn it into a tire, get it on a Caterpillar truck, and ship that Caterpillar truck to its final destination. That requires a lot of energy. So these three sectors tend to go up one after the other after the other. Now, this is not perfect, but this is pretty close. We got industrials leading the way. They peaked out here. They tried to break new highs in July of 2023 and gave us a spectacular fail, dropped below the 3-year and 1-year moving averages. This is a 5-year weekly chart. The reason I'm looking at a 5-year weekly chart for all this stuff, it's so you can be an investor and not a day trader. Day traders should be looking at daily charts, intraday charts. But if you're not a day trader, you should really be looking at your 5-year weekly, because this is telling you the sector rotation, and it's confirming, are we in fact in the early phase of a new bull market? Well, so far, the 4 sectors that are supposed to lead have led. And now the next 3 sectors that should go into mid to late phase, they're just getting started. They're just breaking new highs, first time since 2021. They tried in summer and failed. They finally broke out. They retested what used to be resistance, support. And it sounds like the same story all over again. But man, this rally and this sell-off is a lot different looking than what we're seeing happen in other places like tech. So look at that rally compared to this. You can argue that industrials are looking pretty strong. Not only did they try to break out earlier, but the distance, the percentage move up was bigger, and the sell-off not quite as harsh as what we saw in tech. And lastly, basic materials, right? If you're building a Caterpillar truck, more steel, more iron, more plastic, more rubber, more aluminum, you're going to use a lot of materials. And this one just attempted to break out, little fail, right? I wouldn't call it a major fail, right? It didn't collapse. We're not back down in the middle of the range, but this has got a wider base. So the wider the base, the higher the space. This has the bigger potential as a setup. And you're going to hear this a lot on the internet. People are already starting to chatter about the commodity super cycle. In the cycle of assets that go up, I always think of it as Bear Stearns and Company, BSC. Bonds go up, then stocks go up, then commodities. When commodities go up, they really act as a way to suppress the economy and the business cycle. If you're paying more for gas, if you're paying more for chemicals, you're paying more for your aluminum, platinum, your metals, if you're paying more for all your basic materials, that is a way of slowing things down. We just started to peak out here. And let's face it, if industrials are going up, it has to drag along basic materials and energy. It just has to happen. So we have industrials leading the way, energy and basic materials are just getting started.
So you talk about industrials there really, and before we get into some other questions, I think Dow theory, right? Dow theory is always kind of used industrials and transportations, and they should move in conjunction with one another. So as we've moved into a modern era where industrials and transportations maybe aren't as dominant of the sectors and the industries, we move from a manufacturing industry into a manufacturing sector into a service sector. Like, what does that mean? Is this still a relevant indicator to kind of keep tabs on?
So it's a little tougher these days, right? So when this was created in 1890 by Charles Dow, this was revolutionary. He thought, wow, stocks are a leading indicator. And if I could put together a chart of a bunch of industrial stocks and then compare that to the transports that support them, .djt, well then, heck, I've got a way of knowing what business, where are we in the business cycle? And by the way, he was peddling his newsletter. You may have heard of it, the Wall Street Journal. In 1890, it was a newsletter, and he was trying to convince people to buy this thing. And the way that he sold it was, hey, based on Dow theory, we figured out if industrial stocks are going up, which were 12 industrial companies at the time, now 30 stocks. The word industrials is really nostalgic. But the transports have to confirm. And what do we see here in transports? Non-confirmation. And by the way, folks that are fans of the show, we've actually talked about this because whenever I see an anomaly, like here's industrials, beautiful breakout, early breakout in January before the rest of the market broke out in the S&P, the 30 names in the Dow Jones Industrial Average broke out. Now I have my problems with the Dow. The number one name in the Dow, United Healthcare. Why? It's a price-weighted average from 1890. This is a $500 stock. Apple is a $160 stock. So it's 1/3 the size of the position in the Dow. It doesn't make sense for today, but it does have some historic significance. And let's face it, people, whenever you get a quote about what the markets did, the first thing they always mention, they always give you a quote on the Dow. So Dow breaking out, important. What they don't talk about, though, is the whole story, and that's the transports. Transports, that's a muted rally here. It didn't even make it to old highs. And then it collapsed. And inside of industrials, some of the weakest names, like UPS, some of these names, this should be doing very well. If we're in a booming economy, this chart should not look like this. And by the way, they don't all look like this. FedEx looks a heck of a lot better, but I could go on. But the fact that the transports are not doing it, this is a early warning sign for all things that if we're building it, but we're not shipping it, that means we might be getting a little ahead of ourselves that we don't have the orders in, and maybe it's not all happening the way we think it is. But if we're building, if you build it, you have to ship it. So that's our confirmation is the transport. So I would put this as a, yellow card.
Yeah.
It wouldn't be a red card. I wouldn't throw you out of the game, but you get a yellow card for transports.
Time will tell how that plays out.
I got to get some cards from I got to steal some cards from a soccer rep. I can hold up a yellow card.
Let's just get you a traffic light to hang out there in the background. So you could just have the red light, green light, yellow.
Why not? Traffic light. Okay.
All right. So some questions that came through talks about entry and exits. And I think this is a common question. Like, how might one go about identifying like ideal entry and exits as you're evaluating some of these charts?
All right. Do we want to throw in a specific name? You got something in mind?
Yeah. I mean, let's just start with the Mag 7. There was a lot of clients asking about some of the Mag 7. I'll let you go with whatever one you start with, whether it be NVIDIA or Amazon, Apple, Microsoft, take your pick. Those are popular picks these days.
So you want to go strongest to weakest, or how you want to do it?
Yeah, let's do it.
Okay. So this is not my opinion. This is the chart's opinion. Google is the strongest name in the Mag 7, the FANG stocks, whatever you want to call it. Not only did this break all-time highs and hold here, but in the sell-off, it's not participating. Well, today it is. But lately, it has not participated. So this is like a chart for the last quarter. It says 10-day on there, but I may have expanded this. I like to look at least the last quarter. So this is each day in the chart. Remember, a lot of these charts look totally broken, and this doesn't look so broken. This looks okay. Now, I'm not a fan of that gap down. When I see a gap down, that scares the heck out of me, but it's recovering nicely. So I definitely throw a yellow card at it. But there's other stuff like Facebook, this is going down in conjunction with Facebook. I got to use the new symbol, Meta. I miss FB, and I think so does everyone else. So, by the way, if you miss FB, say it in the comments. Let Trey know that we miss the symbol FB. This thing's down 12% on fantastic earnings. If we want to have a debate about something and earnings versus fundamentals versus technicals, this would be the battleground, right? Beat on the top line, beat on the bottom line, beat. And then, of course, the owner and founder of the company comes on and says, we're going to do stuff in the metaverse and we're going to do glasses. And people will like scratching their heads like, hey, man, the stuff that's profitable, you're not talking about it. And that spooked investors and some of the rhetoric of where they're going to spend their money. And here we are down 12%. Investors have spoken. That's why price leads. Price leads. And when you see a gap down and volume like this is not me and you volume. I'm not buying 60 million shares. Hey, Mike, how many shares, when you buy Facebook, how many shares do you do? 10 million, 3 million? What do you do?
It kind of depends on the day of the week. If I got paid that week, I might go a little bit more.
You might do 15 million. You might go crazy.
I got 3 teenage daughters, man. I can't afford to buy all that right now, right?
I got three daughters out throwing a son to boot. I got 4. So I feel your pain.
You know what it's like.
60 million shares and the day isn't over yet. The day isn't over yet. This is a daily chart. Let's look at that weekly chart. Let's look at the volume just so this way we can see. Look at that spike in volume and the week's not over. We still got a day and a half to go. The volume on this is huge. When you see this kind of move and that spike in volume, that means institutions are changing the portfolio. And we should always be wary, always check your volume. And you'll notice I have all these different time frames set up, and I have a 1-year daily chart, 200-day moving average volume. I call this my clean chart, right? Like if you ever hear people talking about when they have evidence of something, they use a clean room because they don't want to disturb the DNA and the evidence. That's what this is. This is like the clean room of charting. It's a 1-year daily chart, so I can see all the gaps. I've got my earnings on there, so I can see that's what really drove this. And I want to look at just the direction and the volume. So we were kind of going sideways. We attempted a breakout. We failed. The earnings come out and massive sell-off. Now, the only good thing, and you could say this in any time frame, whether we're looking at the daily chart or the weekly chart, the trend is still in place. We're still in an uptrend. We got higher highs and higher lows, but this isn't looking great. This is not a great move. Now, we've already gone from Meta going from 100 to 500, 125 points higher than its old high. So tremendous upside move already. This might be in for a cooling off period. And this kind of fits in with that sector rotation. If financials, consumer discretion, tech, and comm services led the way, we could see all those technology-heavy names start to take a back seat, and that means the Mag 7. So what looks like a market sell-off might really be a sector rotation. Money's not leaving the market. It's just going to where it could serve its best purpose and go up the most. So any other names in the Mag 7? We got 2 so far.
Well, I think you brought up a good point there, and I think it makes sense to just kind of talk about your clean chart there, because there was a lot of questions that came in about what's the best indicator to look for. Everyone's looking for the crystal ball. Everyone's looking for the silver bullet. But I think what you said there shouldn't be dismissed or kind of overlooked. I mean, and correct me if I'm wrong, what I'm hearing you say is really price action's most important. Look at price action first. At these different levels of support and resistance, where we're seeing the breakouts take place, where we're seeing them pull back to, and then volume helps us confirm the strength in any price action. Is that kind of how you're interpreting that clean chart?
Yes. That was a great layout for that, but yeah, you knocked that out of the park.
Well,
so,
hey.
Let's say that we were going into Google, and I said the gap down is circumspect, right? I don't like the gap down, but this has been one of the leaders in the space. It hasn't reported earnings yet, just because Facebook had negative earnings and had some negative things. Google may be spending their money differently. They have a different position on AI. And really, this is a battle for the future. Stock market always has been a battle for the future. It doesn't matter if we're talking horse and buggies versus Ford. It was always a battle for the future. So if we're looking at Google and we're looking at that gap down, but then it quickly is trying to fill that gap, okay, well, that gap down move and that prior low, that 150, that's a pretty decent stop for the very, very short term. Now, I'm not using my 5-year weekly, which I always do, but because of this gap, I'm going to tighten up that stop. I'm looking at 150, and I'll give it some room. We'll say 147, where it came up automatically. And you'll notice we're risking 5%. If I'm risking 5%, I can't make 5%. By the way, I'm using Trade Armor, and I'm using Active Trader Pro. Active Trader Pro is free. It is free to every person on this call. All you need is a Fidelity account. You don't even need to fund the account. All you need is an account number. You can open up an account with no money in it and get access to Active Trader Pro. Data is free, software is free, trading's free. What's not to like? I've got my chart set up here with all these tabs so I can see the same exact thing. Google, I could see it in 50 years, 5 years, or 5 minutes. I could see any time frame I like. Based on this daily chart and the evidence that what Google's saying and the prior low, I'm going to give it a little bit of room, give it a stop of 5%. If I'm risking 5% and I'm getting in today, well, my target's got to be at least 15%. I'm guessing around 175-ish. Let's see if I'm right. Not enough. 178. By the way, over the years, I've gotten better at this game. Oh, so close. 179 and 50 cents. There we are. So I've got a 5% risk for a 15% target. I've got a 3-price system. I've got my entry. I've got my stop. I've got a target that goes off the page close to 180. And I've got a 3-to-1 risk reward. So for every percentage point I'm risking, I've got to make at least 3 times that. So now if the market pulls back, 2-to-1 isn't going to save you. 2-to-1 is going to wipe you out. You're going to take a lot of losses. You might take more losses than wins. And then you go upside down. But if I could get this right at least half the time, and I have a baseline start of 3-to-1, over time I have to win. It's just math. It's statistics. Now, the way to truly win, if I'm in a winning position, let's say we buy it and we don't get stopped out at 147, but this does break new highs and we get close to 180, we don't have to get out of a winner, but we do have to manage one. So for that, I would move up my stop to break even, and I'd move my target from 180. Let's see if we can get to 200. Let's face it, if Google's on a tear for the long term, and we haven't done anything in a long time, Google's been, like a lot of the market's been sideways since 2021, and it wants to break to new highs. Okay, great. Let's break new highs. Let's do it together. Let's roll this thing up to 200. See if we can make a 28% profit instead of 15. I'm trying to almost double my profits, and I've moved my stop loss up for break even, right? I at least want to have a break even. I shouldn't risk any more of my money. I'm right, but now if I'm going to continue to be right, by the way, nobody goes broke taking a profit. You can take a partial profit. You could sell it all for the smaller profit. The great thing about investing, the right answers are the right answers for you. There is no right answer.
I think what you're saying here and emphasizing here shouldn't be overlooked either, because one of the most important components to anyone's strategy that I've seen in my 24 years doing this, they've been very disciplined with how they're managing risk. I mean, that's the one major characteristic that all successful investors and traders possess. They are very disciplined and aggressive with how they're going about it. So Trade Armor definitely gives you those bracket orders. If you're not using them, I think it's definitely worth revisiting how they can be incorporated into your strategy to manage risk more effectively. So I know we got about probably 15 minutes, give or take. Yeah, let's go through some other charts. We'll kind of throw a few out at you. How about, let's go to the chips. What do you say? NVIDIA, Taiwan Semi, AMD, kind of run through those?
Can't have a party without the chips. So let's go through it. So first, let's talk about NVIDIA, because this is the 800-pound gorilla that really runs the show. They're now in the top 10 of the S&P, as is Broadcom. Broadcom is also in the top 10 of the S&P. But this is now a $1 trillion company. It's a big company. It is not going away. It is now about 7 times the size of Intel. So if you've not thought about markets this way, you have to start thinking about how things have changed over the years. NVIDIA came up with a 7-nanometer chip years before Intel. Now they're off to we're talking about 2 nanometers. We're talking about the new efficient frontier. Intel claims that they're going to have one. They're all working on it. We'll see who wins. That's the name of the game, the competition. And NVIDIA, it's been correcting. You had a 200-point correction. So everybody that was begging, like saying, oh, if NVIDIA, if I could just get a pullback, if I could just get a pullback, I'd buy it. Well, earlier this week, you may have missed your window. We went from about 960 to about 760 a share. There's a 21% correction right there. And we got some green bars coming in. So buyers are coming in. What I don't like that my relative strength is now breaking toward the bottom. The last time we saw relative strength this week, we were here. We were here on the chart going in like that nowhere's land where NVIDIA was stuck going sideways for more than a year. And I don't like the amount MACD has already come down, but it looks like we're starting to level off. So maybe we're starting to pivot a little bit. What I'd like to see this downtrend in relative strength break. Now that's a 2-year daily chart. None of those indicators are reliable after all that. If I switch to my 5-year weekly, bingo, my pullback is spot on. It's right in line. It's holding up around 60. I like that a lot. It did just roll over here on MACD, but it's a light rollover, kind of holding that zero kind of tight. So this is a very controlled, tight pullback according to my indicators in the intermediate to long term. And as you can see, my 1-year moving average is spread out nicely against my 3-year moving average. You like to see these things fan out. For my daily chart people, the 20 over the 50 over the 200, you just want to see them fanned out like soldiers, marching in the right direction, headed north. And that's what we've got. So let's go through. I'll do SMH, and then you want to start calling out names.
Yeah.
SMH looks a little bit weaker than NVIDIA, but the same kind of chart. I don't like my relative strength's a little bit lower. I don't like that. But everything else is holding up pretty well. In fact, I don't like it a lot because if you look at from where this low was to this, the price is a heck of a lot higher. My relative strength is a heck of a lot lower. So I will keep an eye on this. This is definitely a tell. I don't like, look at how much higher price is and look at how much lower my relative strength is gone. Don't like that. And the roll on MACD on a weekly, all right, I'm starting to like this a little less. And let's see what other leadership we have. You want to name like 4 semi names?
So we're looking at AMD, right? That was the other one. NVIDIA, Taiwan, Micron, Intel. You know, those are a few of the ones that come to mind.
So my 5-year weekly chart, there's been a red bar bloodbath here. And what should have been support did not happen, right? We should have had some support here. The old highs from 2021 should have gave us some support. Snapped through it like a twig. Next area of support would be these old highs. Oof, we're a ways away. That's the 1-year moving average we're headed towards. Don't like any of this. You could argue to the left, we've got some support here where we did pick up support. These green bars, there was a red bar in between. There's a little sell-off and it kind of picked up steam and really took off from there. We're getting some support here, but I'm going to really need a diesel bounce here. And of course, if this thing rallies to 180, everybody's going to be thinking the same thing. Head in the middle, shoulder on the left, shoulder on the right. So for me to feel really confident about this again, I'm going to have to be north of 180. Until then, nothing wrong with taking profits if you got them, because if the semis want to correct, and it looks like AMD is kind of leading the correction, I don't want to be in the thing that's leading the correction. I want to be in the strongest names.
You talked a little bit about patterns there, potential head and shoulders. Maybe it's saw a peak of a flag a little bit on NVIDIA. I mean, how much emphasis do they place on some of these patterns and candlesticks? That's what some of the questions pertaining to is candlesticks and patterns.
So the candlesticks are like, it's like reading the music. It's like reading music notes. Like I can't read music notes. I can't play any instruments, but there are people that see music notes on a sheet and they see a symphony. They can hear the orchestra in their head. These are the patterns that you see on candlesticks. Like for me, looking at this is a whole language of the money. Where did the money go? It's the footprints of the money. The first thing I do is I look for patterns. So we had an uptrend, we had a sideways correction, another uptrend, price correction. Different than the time correction we saw here, where we went sideways for a year, just slowly letting the uptrend catch up to us. This has been a massive price correction, very, very different look. But in the end, they get to the same place, the trend line. So let's draw the trend line. This was our old low. Here's our low here, and we're right on top of that 1-year moving average. Not that surprising. This is our area of massive support if it comes down to that level. Let's hope it doesn't do that. But you also have to think about the pattern of sequence of how things sell off. They tend to like to do an ABC pattern. Wave A goes down, wave B is a counter rally up, and then wave C is the next wave down. Not to say that that could happen, but it could happen. It wouldn't be that shocking. If you look at the daily chart, you may already see that. You might notice we did have a wave down, we did have a counter rally, and we did have another sell-off, and we are catching a lot of buyers in the last week. So you could argue that may have already happened in the shorter term time frame. Either way, still a heck of a bullish chart, way up and to the right. And there are others. Broadcom, also in the top 10 of the S&P, that's really holding on tight, giving a sideways correction, not giving up as much in price. Applied Material has been extremely bullish, except for the last week. It was really holding up very, very well under all this. And if we look big picture at SMH, and we're looking at that 5-year chart, let's be realistic. This has been one heck of a rally that was overdue for a correction. And this has been going sideways for years, right? We got 2+ years of sideways move. It breaks out. It touches what used to be resistance, became support. Had a heck of a nice rally and a pullback, kind of like the textbook says, but not loving that relative strength. So we might be getting some sector rotation. I can tell you software is even weaker looking, right? It didn't break new highs. And here we are correcting, and we never even made new highs. So software is weaker. There are weaker subsectors within tech.
Well, we got a few minutes left, and we can get into more of what.
Oh, I forgot. We're only 45 minutes this time.
I know, man. You said time's going to fly, and it absolutely has. But let's get to what the people want. The people want to see more charts and more stocks. So a few have been sent in ahead of time. A few have been sent in real time. Speaking of which, I think we about broke the system whenever you asked who wants FB back instead of Meta, because we got hundreds of responses saying,
you know how many times I messed that typing up?
Yeah, bring back FB. But let's look at GLD. How about that? Let's drift into metals a little bit. GLD, SLV, what are the charts telling us there?
All right, so here's a 5-year weekly on gold. This has been a go nowhere trade forever. If you've been waiting for gold, and by the way, if you ever ask me, you say, what do you think of gold? I always say rocks versus stocks. I'll take stocks every time. Stocks have earnings. They have unlimited upside potential, and gold, it's a rock that's important. It's a rock that has interesting properties. There's some industrial uses, but if gold went nowhere for decades, nobody really cares. Like, you're not going to really make your portfolio on gold until you're in an uptrend. And guess what happened? We broke out in gold in spectacular fashion. And the reason why? Usually it's the dollar. The dollar's been in rally mode, which is bizarre to see the dollar in rally mode with gold in rally mode. Could you imagine if the Fed actually cut rates and the dollar went down in value, what gold can do after that? So it's looking interesting here. It's an uptrend. Every pullback is buyable. I would look for some sort of a decline that makes sense. So if you guys want to vote, tell us in your comments, rocks versus stocks. What do you like? You can't not like gold. I like anything that's going up. I don't care if they sell microchips, potato chips, if it's gold. But if I could get a pullback, a 38% pullback from low to high, 207. And by the way, I'm using our Fibonacci retracement lines, some of the many, many tools you have in your toolbox. And you could determine what the high and low is. It's a measuring stick. Nothing is predictive. But if this thing came back to 188, according to that, 186, somewhere in that range, I'm sorry, 288, that would be a 1/3 retracement of this massive move. Generally, when you have these very strong moves, they do very shallow retracements. You might only get the 23.6. That gets you in at 213. It's okay to average in. Buy some at 213, buy some, am I saying the right number there? 213. Oh, it's 208. I'm sorry, 208. Sorry, it looked like an 8 in there. Should have made this a smaller chart, make it a 2-year. There we go. Now we can see the numbers. Any of these numbers are a decent pullback area for this. You've had a unbelievable massive run, and we're getting a little bit of a pullback. You could always leg in on the way down. Ultimately, the main thing, it cannot go below 185 where you started off the trend. Can't go below the zero line if you're using this as your tool. You've got to hold up. In fact, shouldn't even go below the 2/3. Shouldn't go below that 200 line. But any of those numbers in between are all decent pullback.
What about silver? Similar pattern in silver?
You know, silver is 1/17 the amount of silver as gold in the crust of the earth. So there's 17 times more silver. If silver were 17 times the price, except 1/17 the price of gold, silver should be like, I forget, the number now might be in the 300 or 400s. It's nowhere near that. It's crazy. So silver, you could say, is way undervalued. The last time we had a big run in silver was back here. It was the Reddit crowd in 2023, ran up the price of silver, and it never went down. It got stuck in this trend toward the top. Nice recent breakout, nice decent pullback. Known as the poor man's gold, it's a trade. You know, any of this stuff, I think of it strictly as a trade. It's not something that I want to think about as being crucial to the portfolio because let's face it, NVIDIA can grow earnings probably a lot quicker than gold can show its scarcity. There's always new gold mines. There's always, the gold miners are starting to combine. So we're looking at consolidation because they've been depressed for years, just as the gold industry is taking off. So it's becoming an interesting industry at the moment. There's no doubt.
We'll touch on just a couple more rather quickly. We'll look at, we haven't touched on Tesla, any of the EVs, Tesla, Rivian, those kind of came in the mix from clients as well.
I told you time goes fast. That is not an uptrend. I'm sorry. I know there's people that love their Tesla. I know there's people that are huge fans of Musk. I can't make out if he's P.T. Barnum or if he's Thomas Edison. He's something in between. The guy is revolutionary in his thinking, but I'd really like to get to Mars. I wish he wasn't doing all these other things to take away his attention and focus. Also, if I'm a shareholder of Tesla, I'd like him to stop selling shares and focus on getting out that low-cost production Tesla that he talked about. The rally that came out, and again, this is, if we needed an argument for fundamentals versus technicals, this is completely opposite. The stock went up 12% in a day on bad earnings. 50%, it was less revenue, and I think the earnings were down 50%. I mean, just shocking stuff that would destroy another company. But because Elon Musk came out on the conference call completely different than Zuckerberg, he convinced the market that they should be buying his stock, and they did. Stock went up 12%, but it's a rally in the downtrend. This is a nasty, nasty looking downtrend to me. And until this thing is north of that blue line, I need to see proof in somebody else doing the heavy lifting. I'd rather be a late participant in an uptrend than an early participant in what becomes a bigger downtrend. Not interested.
Well said.
By the way, Mike, you want to know my favorite stock?
Bring it.
The ones that are going up. I don't care what it is. They could sell microchips or potato chips. If it's going up, that's the stock for me.
That's classic. Classic John Gagliardi. Fantastic. We got time for one more. Let's kind of squeeze one in. CMG.
I'm going to give you a host of home builders.
Do it.
PHM, Pulte Homes, probably the strongest in the bunch. Look at that uptrend. What's not to like? Every pullback is buyable. You got to pull back. Nothing wrong with that. The people that support home builders, names you wouldn't think about, like United Rentals, just put out earnings, kaboom. So you had a huge bar here. We used to call this like a 20/20 bar. It's an engulfing bar in the candles, engulfing all the other candles. And what'd you get this week? A green engulfing bar, engulfing the red. It's like Pac-Man getting eaten by a bigger Pac-Man. And in that same space, BLDR, there is no shortage of names that are in massive uptrends going up as part of the home building craze. There's not enough homes, too many people. The demographics, millennials don't lie. Their average age is 33 years old. What were you doing at 33? Well, if you got married, you had kids, you bought a house, you bought a car, and then you need another car. And that's what makes things go. And right now we got a massive shortage of housing, can't build houses fast enough. And that's the secret of their success. Huge demand, not enough supply. And I don't care what name you throw at me, They all look the same. They're up and to the right.
John, a lot of good insight. Appreciate you taking time out of your day. I know carrying a similar schedule to you, we kind of keep busy days, but this is always good to get out and kind of talk the charts and get the insights to our clients. And if you're interested in learning more about technical analysis, there's a tremendous amount of online webinars that you can take out of the comfort of your own home. They're on demand within our Learning Center. So just go to News and Research on Fidelity.com, and then down at the bottom, you'll find Learn. You can sign up for the topics that you see are most important to you. Certainly, if you wanted to meet with someone like John or myself in your local market, just reach out to your advisor. They'll put you in contact with the local regional brokerage consultant. We'll be able to go through in more detail and discuss some of the tools and resources that John's taking us through here today. So I just wanted to thank all of you for joining us for today's session. This is session 1 of 3. So we'll take a quick break and we'll come back at the top of the hour at 2 o'clock. And you'll also be receiving a thank you email later today. So please read it and it'll direct you to some of those additional resources. So with that, John, again, thank you so much for your time and insight. I appreciate it. And definitely we'll look forward to seeing you at the 2 o'clock session. Thanks, everyone.
At the 3 o'clock session, who do you think's going to win, fundamentals or technicals?
Well, you know I'm a technical guy, so I'm going to fall in your camp. So Pete's got a deck stacked against him, man. We're coming in strong.
Yeah, he's coming into the Lions den here. Somebody's going to have to tell me how could Tesla go up with those bad earnings and how Facebook went down with those fantastic earnings. Oh, Meta, sorry, Meta. This is the reason why it's down, is the metaverse. That would be the reason. I think the reason's right in the name. Like Madoff, like, hey, you got to figure out what he did with the money. He made off with it. It's right in the name. It's the same thing here, right? Meta, this is really the reason that this chart did what it did, because top line earnings were fantastic, bottom line earnings fantastic. Heck, I can't wait to right click on this thing and show people the earnings in session 3.
Well, it'll be fun. We'll save Apple for session 3 as well. I know there's a popular one. We'll revisit that one in session 3, fundamentals and technicals. How about that?
Sounds good to me.
All right.
That is
Take a quick break. Be right back at the top of the hour. Thanks, everyone. We'll see you shortly.
Bye, guys.
Hello, everyone, and welcome back to our second session of the day, following the fundamentals. Let's see here. I'm going to close that. Let's go. Sorry, we got a pop-up asking me to do a forced restart in the middle of my intro, so I will restart my intro. So my name is Michael McCrary. I'm a regional brokerage consultant here for Fidelity Investments. And I, along with my colleagues across the country, we work with a lot of our self-directed clients, helping them better understand strategies and better leverage the tools and resources at Fidelity to be a successful self-directed investor, really optimizing their overall experience. So this is our special monthly event with the fundamentals and technicals. But this session, first session at 1 o'clock, we went through, and John Gagliardi and myself, we kind of walked through some of the technicals, and John told us what the charts were telling us. And in the second session today is following the fundamentals with Pete Stringfellow. But before I jump in, just wanted to mention the online audience. We definitely have one more session that's following our 2 o'clock. So we're going to put it all together. We're going to bring the fundamentals and the technicals, bringing them together, how to build and manage a strategy using both technicals and fundamental research. So please stay tuned for that one if your time permits. A couple of housekeeping items that just to be aware of. If you do have any questions, over to the right-hand side, you can access our Q&A. You just pop in, fire a question. We got a team that's addressing a lot of the questions as they're coming through. We might not be able to get to all of them as fast as we can. I think we, in the last session, we had probably close to 400 questions that came in, because we have, close to 30,000 of you registered here today. We'll get to as many of them as we can. There is closed captioning. So if you're wanting that and you're viewing online, just that below the video player, you can actually turn that on and off. So with that, we'll go ahead and jump into following the fundamentals. So Pete, tell me, you ready to put the fun and fundamentals for us today?
Man, I live in the world of fun.
Right. That is I'm ecstatic. I'm glad to be a part of this one. I know you've been doing a lot of good work here with this series, just as John's been doing with his technical session. But what do you say we just kind of talk about macro first, start macro, and then we'll kind of get into some of the more detailed fundamentals. And for those viewing online, I mean, we definitely are gathering your client questions. A lot of the series that we put together here today, it's really built around what you wanted to hear more of. So we've kind of put together a list of your questions to go through and kind of demonstrate the tools and resources to help you evaluate fundamentals as you're making some of the decisions with your own account. But let's kind of talk about the overall market first, Pete. Like, think about macros, thinking about fundamentals. What's your point of view as we stand today?
So I think similar to many folks out there who like to stay in tune with what's happening from a macro perspective or from a micro perspective, a lot of perspective has probably shifted over the last 4 to 6 weeks, in particular around policy decisions, right? Now, when I think about technical analysis versus fundamental analysis, by the way, I felt attacked listening to John's technical analysis webinar. Just kidding. I think, okay, these two aspects of analysis need to work together to some degree, but they have their own place, right? As far as where they fit. And then beyond that, if I'm thinking about other arenas of analysis that one should incorporate into their system for making decisions within a portfolio, you can't forget about top-down analysis, and think about these concepts as like a very large Venn diagram, because there's always some overlapping elements to the different aspects of how you go about conducting analysis, right? So like, yeah, you got fundamentals, you got technicals, you got top down, you've got bottom up, you've got portfolio analysis, which is really important that a lot of folks don't consider. It's like, what is your portfolio exposure? And then you also have the security analysis side of it. And to me, that's kind of where, like, in particular, fundamentals and technicals oftentimes merge. But when we look at just this broader macro picture right now, what's really changed? Well, what's really changed is expectations related to rate cuts, right? So, McCrary, I'm curious, do you recall at all, say like back in December, what the Fed funds futures were telling us in terms of probability that rates would still be in this current 525 to 550 bips Fed funds rate dynamic? Do you remember what they were?
Powell came out and said he's offering 6 cuts this year. That's what everybody was expecting.
Exactly.
Last year, right? 6 cuts.
Exactly. Yeah, and if you've heard of the Fed Watch tool, which is a tool available through the Chicago Mercantile Exchange website, it is basically a tool that gives you an analysis of what the market thinks the probability is of the Fed funds rate changing between now and any given date out into the future related to FOMC meetings and rate policy decisions. And to your point, McCrary, like back in December, there was a 0% probability that rates would stay in this 525 to 550, so 5.25 to 5.5% range at that Fed funds rate level. You fast forward now to April 25th, today, there's about a 18 to 20% probability that by the end of the year, in December, Fed funds rate is still 525 to 550. So think about that for a minute. That has broad sweeping impact to assessing that top-down strategy, and then from there, assessing fundamentals across the market. So, what I think about related to building hypotheses around asset allocation or identifying opportunities across markets based upon these overarching themes, it makes me think I've got to go in and reassess. I've got to get in and start to actually analyze, like, what are fundamentals telling me related to different sectors of, let's call it the equity market? What are fundamentals telling me in relation to risk on versus risk off if I'm trying to determine, asset class exposure between equities and bonds based upon the current dynamic as opposed to my life circumstances? Yeah, I might start to lean a little bit more toward those defensive or more cyclical areas of the market, simply because of some of these dynamics.
And I think that just speaks to us, as investors, needing to remain nimble and needing to stay on top of the changes that are taking place within the market. Because to your point, whenever Fed came out and announced potentially 6 rate cuts in December, it was risk on, right? You had a lot of those growth oriented names kind of anticipating, we see the light at the end of the tunnel. We had a really nice move higher in the broader markets. But at the same time, as things have kind of started to simmer a little bit in the rate cut environment, you started to see things rotate over a little bit, and they're more defensive in nature, right? That's when we're seeing things kind of play out.
Yeah, in fact, if you just look at the first quarter of the year, like, okay, well, what really happened from a macro perspective? Well, we saw stock prices increase and we saw yields go up, which means bonds went down, right? Because you have that inherent kind of teeter-totter relationship between price and yield. So to your point, like, well, stocks are going up. It's a little bit more of a risk-on situation. So now as we start to take a step back and think, okay, we've gone from 6 to 7 rate cuts, now maybe 3 rate cuts between now and the end of the year. Like, how does that impact or affect my decisions related to asset allocation? Now, there's a lot that obviously we could assess from that macro or top-down perspective. But when we start to get into the numbers, that's where the fundamentals really start to come into play to help us get a gauge. And you also have to consider it's all relative, right? It's a relative gauge, meaning what do fundamentals look like within a specific sector relative to the companies that are a part of the sector, or an industry relative to the companies that are a part of a particular industry. So because a lot has kind of changed here over the last quarter, let's call it, we have some very interesting perspectives related to, okay, where do the opportunities lie? Not only that, but what might we see in terms of economic development and growth moving forward, by way of considering where we've been over the course of the last year, let's call it.
So that actually kind of leads into a couple of questions there, right? And I didn't mean to cut you off. Go ahead, Pete.
No, you're fine. Just real quick before the question, you and John were talking a little bit about the Magnificent Seven, right? So I think it's really important to call out the Magnificent Seven impact, not just from a price movement perspective, but also from a fundamental perspective. And I know during this following the fundamentals, oftentimes, just about every session we do here, we kind of hit on the quarterly market update. So I just want to highlight for folks here really quickly where I'm going to, just a citation to this chart that I'm going to highlight for you all. When you go into our news and research tab on fidelity.com, you'll notice you can get into markets and sectors. Right after you click into the landing page for markets and sectors, at the top right here, you've got a link that will take you right into Fidelity's quarterly market update. So you have a very new, fresh update that's available that assesses Q1 calendar year for 2024. But in particular, one of the highlights that I would throw out to the audience here is related to the Magnificent Seven and the composition of the US equity returns when you consider the top 7 stocks versus everyone else in the S&P 500. Right? Because as you can see with the graph on the left, price appreciation from the top 7 was up 143%. And in Q1, it was 17%. Right? So, John would likely argue a lot of this is tied to technicals. It's momentum. And I don't disagree. Right? A lot of it is tied to technicals and a lot of it is tied to momentum. But what is that doing to the valuations? Well, think about it. If the market on these 7 stocks was up 143%, were earnings up 143%? Or did we expand the multiple from a valuation perspective, making those companies a bit, let's call it richer, right? Or maybe coming into the overvalued territory, depending upon how you define it. So what's really interesting is the S&P 500 minus the top 7 stocks, when you look at it from a return perspective, all of the return came from PE multiple expansion because earnings per share were actually down, right? With those 493 or so companies. But the top 7, the Mag 7, yeah, the earnings were up nearly 40%. And then the rest was multiple expansion. So yeah, highly likely there was a momentum movement, or I should say a trend with momentum continuing to push these companies higher. Now, granted, in the last week, of course, we've seen more volatility come into play with these companies, but it's always, to me, very important that you build a foundation when you're doing research or starting your research process around the current state. And that's why, Michael, I love the question that you posed just at the beginning. Like, what are we seeing? What does this macro picture look like? Because it helps us stay informed, and that information is likely to affect other decisions or other research that we're doing, and ultimately the decisions that we're going to make based on the research. So yeah, let's jump into the questions.
Yeah, I mean, just that quarterly market update is really important. I mean, we just published that last week. And for those that are looking for a shortcut here, the other way to access this is fidelity.com/QMU. So it's pretty simple, quarterly market update, QMU. That way, I know a lot of clients will bookmark or save those as a favorite, but a lot of good content to stay on top of the macro environments. A lot of these questions kind of overlapped a little bit, so I'll kind of try to weave these in a little bit. But one is, are there any markets that look more attractive as we look ahead, and why? And kind of in a similar tone, where are we seeing the business cycle and what sectors look good at this juncture?
Yeah. Okay. So let me give you just a quick answer on the first question, and then I'll expound on that answer after hitting on the second question. So to the first question, I think one of the elements that John Gagliardi highlighted toward the end of the session kind of applies here. He highlighted real estate, right? And in particular, he was highlighting home builders and highlighting the trend, the uptrend that these companies are in. Well, when you start to assess fundamentals in the current state, you'll actually see that fundamentally, especially when you consider the potential for an environment that is decrease in rates with earnings growth, yeah, real estate is a very opportune sector, right? And then some of the other cyclical sectors are also looking a bit more opportune. Right? Now, why might that be the case? Well, just circling back to the quarterly market update, in every one of these updates, what our asset allocation and research team does here at Fidelity is gives us a baseline of where they see the US currently within this economic cycle expansion based off of the 4 different phases of the economic cycle, right? Now, what's interesting is oftentimes folks think that the cycle is linear, meaning it's just going in one direction. But reality is it's anything but linear, right? So when you come into a resource like this, you can see that, the US and other developed and developing countries are right now very much so in the late cycle expansion. And looking at that, you might think, well, geez, we've been in late cycle expansion for a very long time based off of these quarterly market updates. But what's interesting is when you get into the details, for example, of the last 4 quarters with the US, we saw 3 quarters very much so toward the latter end of the late cycle. What has happened in the last quarter? Well, in the last quarter, we've seen the economic cycle actually move backward to more of an early portion of that late cycle phase without ever having gone into a recession, right? So why is this important? Well, because it helps inform us on where we might consider looking for additional opportunities. Now, if you click into some of these resources, you can learn more, but in particular during the late cycle expansion, typically you start to see 4 different sectors of the market produce outperformance relative to market. That's all backward looking, right? So, Michael, we always talk about how past performance is not indicative of future results, but it definitely is helpful to look at to know what has happened in the past when different situations arise. So what we can do from here is we can kind of take this concept of, all right, like where are opportunities from a fundamental perspective broadly across, markets and sectors, because you also think like from a higher perspective of looking at, let's call it sectors of markets, we're thinking asset class, right? So like right now, what is really opportune from an asset class perspective that has not been opportune for a very long time? Well, it's yields, it's bonds. You can get higher yields for with relatively low risk when you consider treasuries at 5% and change. So if you're one who is concerned about the potential future of a pullback in equity markets and the potential for rates to fall, well, that is an area where bonds start to become a bit more opportune. But if we're looking at just the equity side of the market, that's where we would want to dive in a little bit deeper. And we give our clients a lot of hand-holding to do this deeper dive. So like Michael, you highlighted the quarterly market update. I'll give you all another URL to bookmark. It's fidelity.com/QSU. That stands for quarterly sector update. You can also get to that from the markets and sectors page. If you noticed when I was showing a moment ago, you had the quarterly market update. Right below it, you had the quarterly sector update. So this is a deep dive that Denise Chisholm puts together every quarter. She's the director of quantitative market strategy here at Fidelity, which means quantitatively she's assessing fundamental data and she's assessing technical data. So she's kind of marrying these two concepts of analysis together to some degree. And she's also looking at business cycle factors, right? So when we come into a report like this, and keep in mind this page that I'm on within Fidelity Learn is kind of a summary, but you can get into the full report here. And what the full report provides for you is a lot of really interesting insight into what the data is telling us. So when I say, for example, real estate is looking like it may be a more opportune sector right now, fundamentally speaking, well, there are different factors for that, like lower rates and higher valuation spreads suggest attractive risk to reward ratios, right? So what Denise does in this report that we put out every quarter is she gives you perspective on where she would overweight or underweight exposure across different sectors of the market. Now, just for the audience, Michael, could you expand a little bit on what that even means, like overweight versus underweight versus market weight?
Yeah, I think that's fair. Just scroll up to that next slide just above there. And I think it gives us the weighting within the S&P 500 of these sectors. So that last column, yeah, there you go. So if we were to just take communication services there as the example at the top, the weight in the S&P 500 is 8.6%. That would be the market weight. If you're wanting to track the index, that's essentially the weighting within communication services. And then down below where you get Denise's scorecard, communication services is a slight underweight. So if you're thinking about your portfolio, you want to have slightly less than that 8.6% allocation. And that's kind of the more tactical approach, right? Trying to be a little bit more tactical, lean into some of those sectors that are positioned for strength and kind of reduce exposure in those sectors that might be positioned for weakness in the months ahead.
Yeah, no, thank you for giving that overview, Michael. And you'll notice here just in the matrix that Denise is providing from a time horizon view. Well, obviously, when we're assessing a longer term investment strategy, we're looking at fundamentals and valuations. Shorter term is probably more like relative strength. But in the case of communication services, the fundamentals don't look great, nor do the valuations, right? Not surprising considering how much communication services has run up over the last few years. Because if you think about, the Mag 7, I believe 2 of the 7 are in communication services, right? You got Meta, and Facebook, for John, and you've got Google, right, or Alphabet. So there are a lot of different methods one can take to start their assessment across the macro landscape. Think top down, along with the fundamental analysis of actually getting into the ratios and getting into what defines these valuations, like what defines a company as being overvalued or undervalued. But having that baseline and that foundation of where to start is absolutely critical, which is why during these sessions, we always kind of hit on that macro element of where are we within the business cycle. And then from there, because past performance is not indicative of future results necessarily, we want to do a deeper dive and double click into the actual data that is going to give us the ability to create a hypothesis as to where we see opportunities across, in this case, sectors of the market, which is exactly what Denise is doing.
So that's a great segue. We start macro first, get big picture, then we're kind of drilling down into a little bit of the fundamentals, and that kind of transitions the questions. But these two kind of align with one another. But first, if someone's wanting to look and learn more about financial statements from a company, I mean, where would you go on Fidelity.com to even find the financial statements?
Yeah, so I love that question because there's so much embedded within Fidelity.com. And I'm just going to use NVIDIA as the example here, just because I think looking at their fundamentals is fun. Okay?
Not a recommendation, Pete, just strictly used for illustrative purposes.
Yes, absolutely. Look at, and you said that in italics and small font. So let me do this. I'll go into Fidelity.com here, and I'm just going to plug in at the very top right the symbol for NVIDIA. Pull up NVIDIA's stock research center dashboard, if you will. And what we can see is that there's a lot of information on the page right off the get-go, but most of it's related to trading, right? In the sense that we see the bid, the ask, the day range, the volume, and so on. But then as you start to scroll down, you'll see that there's a lot more info for you. And if you want to get into financial statements, for example, what you need to do is shift from the overview section here, just below buy, into the statistics tab. And what the statistics tab is going to do for you is it's going to give you 4 different cards of information. You have key statistics that compares the company versus the industry. It'll do this with growth metrics that are fundamentally based, profit margins, also fundamentally based, valuations, and so on. You'll also see that you have financial statements. This is where you can get into the weeds, if you want to get into the weeds. And you have the ability to toggle between balance sheet, income statement, as well as cash flow. And then in terms of the time frame that you want to look at, you can decide whether or not you want to look at this based off of a quarterly look back or an annualized look back. But this is where the data is held, Michael.
So it's a lot to digest if you start to go through each of those financial statements, and it really takes someone that's trained to kind of understand all the ins and outs of them. But when you think about a lot of the fundamental metrics that one might look at to evaluate the quality or strength of a company, they're really derived from these financial statements.
Yeah, spot on. And especially for the any day independent-minded investor who likes to make decisions on their own for whatever reason. I'm one of them. I think you're one of them. We work with them, have worked with them for decades. And what we try to do here at Fidelity, and in particular, regional brokerage consultants and different folks within the brokerage arm of Fidelity, is we try to help clients understand that there is a lot of hand-holding that we provide within Fidelity.com, right? So I'll start just in one other area, and then I'll kind of come back into this page. But if you don't know how to look at a financial statement, if you don't know what fundamentals are, if you don't know which fundamentals you should be looking at based off of your hypothesis or how you're formulating the hypothesis, you definitely need to spend some time within Fidelity Learn. So from the News and Research tab, clicking into Learn, I'll just bring it up in a new tab here so we can jump back up quickly over to this one. But notice how within Fidelity Learn, you can go right into the topics section, and you have like financial essentials, life events, investing and trading, analyzing stock fundamentals. There are a lot of really great resources here to help our clients learn the foundation of decision making. Now, beyond that, if it's like more of a situation where you're like, I'm pretty familiar with the terminology, the science. I'm not familiar with the art of making decisions because my emotions get in the way. Well, that's where it's absolutely critical that you build a process for decision making, right? Where you're articulating what criteria you're looking at, how often you're looking at it, and what you're going to do with it. But you'll notice here under sentiment for NVIDIA, in this case, we give you hand holding that is fundamentally based and technically based. Okay, just to hit on kind of what John was talking about in the last session. You have a summary of technicals here. Like what has happened short-term, mid-term, long-term within the technicals that are currently live and active in the chart. But then if you wanted to kind of take a step back and say, okay, I'm more so assessing whether or not I want to own a company for the long term as opposed to maybe taking advantage of what I think is a swing or a momentum in the market. That's where this fundamental analysis card can really be helpful for you. Because when you click into more on fundamental analysis, this is a summary of the 4 thematic arenas that really fall under, call it the security analysis side of decision making, where you can say, all right, where does NVIDIA fall in terms of valuation compared to others in the sector? How about quality? How about financial health? How about growth stability? So there's some really good insight that folks can glean just by knowing where to click within Fidelity.com.
I'm glad you brought that up because that actually addressed one of the questions that I was looking at. It just says, what are some important metrics that you should pay attention to, fundamental metrics that you should pay attention to? And that S&P card, if you will, that does a really good job of giving you the specifics for that company and that sector. Because if you think about what's the best fundamentals to look at in, technology, well, that's going to be a completely different set of fundamental metrics that one might look at in a utility company or the utility sector to gauge the quality of that sector. So the S&P does a good job of kind of giving the mix that might be more specific to the sector that a stock falls under. So something to keep in mind there.
Couldn't agree more, Michael. And one of the comments you just made related to, it's all kind of relative. Like, let's talk PE ratio for a moment, right? Because what is PE ratio? Well, it's price divided by earnings, right? It's the PE ratio. How often does it change? Every second of the day that the market's open. Technically, it's changing because the prices are changing, right? But it's not likely it's going to change significantly based off of earnings outside of 4 times a year, right? Because that's when we're actually going to get the earnings per share mark. Now, what if we were comparing a company in the tech space to a company in the staples space and looking at PE ratios and comparing them? Michael, would that be a fair comparison?
Not close.
Not even close, right? So it's all relative. You need to compare the individual company to either the industry that it is a part of or to the sector that it is a part of when you're kind of getting in and saying, okay, from a fundamental perspective, which metrics make the most sense for me to look at? So anytime clients ask us, like, well, what are the top 3 fundamentals I should look at? The answer isn't always the exact same because it depends. Like many responses in the world of investing, the answer is it depends. So yeah, I'm really glad you called that out.
They talk about PEs. I know that's one of the metrics that tends to be pretty popular. And one of the questions that comes in says, I see many stocks with very high PE ratios. Is this normal, or is it something unique to this period in time that we're in? So that's a fair question.
It's a very fair question. In fact, it's also a question that begs the consideration of which market are we talking about, right? Are we talking about the domestic equity market? Are we talking about emerging markets? Are we talking about the global equity market? Because it's all a little bit different and nuanced. So I bring that up because when you start to get into, comparing markets, especially markets on the equity side, there was a really interesting highlight in the quarterly market update here over the last week that goes a little bit deeper into these valuations, and in particular equity valuations in the US compared to developed markets, or developing markets compared to emerging markets. And so when you look at this current state, equity valuations here in the US, while not at their peak, which they peaked during early COVID, 2021 into 22, like no surprise considering the Fed, through 7 to 8 times at the wall than what they did in 08, 09 in terms of monetary stimulus to some degree, right? Or at least dovish policy. But notice the asset allocation research team, that's this AART here, this highlight, secular forecast. So secular, meaning long-term forecast, would be that the valuations come back to 20, right? And on the DM side, 17, and on the emerging market side, 13. So you got to ask yourself, how can that happen? Like, what are the two ways for valuations to come back down to earth? Well, either prices go down or earnings go up and prices stay flat, right? Because if earnings are going up and prices are going up, your valuations aren't going down necessarily. So I think that's a very astute question. This graph, I think, gives you a good idea, at least over the last 14 years, on what equity valuations have looked like at an indexed mark of 2010. But yeah, while we're not at the high, we're up there in the US.
So we're at a pretty critical time, earnings season, and a lot of updates are coming out. So it's just like whether or not these companies are able to grow into their valuations or where they sit right now. And we'll learn more as the weeks evolve. There were a series of questions that came through regarding dividend-paying stocks, and more specifically, what fundamentals should one evaluate that goes beyond just yield? As they're trying to calculate and identify what are some good candidates for dividend-paying stocks. And Pete, we've seen it before. We sit down with clients and they just look for what are the highest yielding stocks and without really looking for other things. So help us go through and see what else is out there.
Yeah, I love this question because when you start to think about the art of how to make decisions, like the science is pretty plain vanilla. Like you read, you learn, you memorize, you have a glossary in your mind. But the art is where it gets difficult. Yeah. So if we get into the news and research tab and just click into the Stock Research Center, we give you some hand-holding with this, but we also give you tools that give you full autonomy to choose, to pick and choose which fundamental data points you might want to look at that aren't tied to necessarily any strategy. But if you don't know which ones might make sense, meaning which fundamental data points might make sense for a specific strategy, like in this case, a dividend-paying strategy, I would really encourage you to use our independent expert strategies here. Because what these are, they're third party. Fidelity pays a third-party research firm, in fact, a variety, to put together strategies with defined criteria and a summary of what the strategies are and what to watch out for in terms of false positives that might pop through when building a screen to get a list of stocks that match the criteria. So if I'm thinking about just broadly speaking, let's just call it which fundamental insights might I want to incorporate into a dividend strategy? Yeah, yield is obvious, right? Because it's going to help me understand how much income I might be able to get. Dividend payout ratio is critical because it gives us some insight as to whether or not the company may be able to continue to pay that dividend, or maybe even increase the dividend or decrease the dividend. Dividend growth is also another factor that a lot of folks like to look at especially if they're into like the aristocrats of 20 years of growth on dividend and growth on earnings and so on. I would also consider financial stability. So, like what does the cash flow look like? What kind of debt levels are there? Earnings growth is also going to be an important one. And then depending upon the sector that you're considering, you may look at or consider the sector trends. But what you can do just here on the screener tools within this Stock Research Center is launch the stock screener. And you'll actually notice that the way we break these out in terms of the criteria that you can choose to start to get a list of opportunities that you then start to assess is right here under dividends. So you got 8 different criteria that you could potentially incorporate into a screen or a strategy that would help you assess and make decisions. So you got yield, you got payout percentage or ratio, you got growth rate, you got dividend coverage. Now, again, if you don't really know what to use of these, where you would want to start outside of Fidelity Learn would be coming into the strategies and saying, all right, well, what are some of these most popular strategies or specific theme of strategy? So like here, I got high quality dividend payers. I've got dividend growers. I've got income and growth. Well, I can click into any one of these strategies, and what the tool does for me is it pre-fills all of the criteria on the left. So I know that Zach's investment research thinks that in terms of identifying high quality dividend payer stocks, it's critical that I look at dividend yield, EPS growth, price to earnings, cash flow, and then a few others, right? So I think that is such an important element that our clients need to understand is available to them. Handholding. There are so many different resources that can help you look at and learn how to analyze fundamentals or how to get a list of stocks within fidelity.com. But Michael, anything you would add there?
No, I think that's really one of the things I try to emphasize with clients, because I think whenever I'm meeting with clients and are looking at dividends or saying, hey, I'm a value investor, or I'm looking for growth, they kind of have a general direction as to what it is they're wanting to look for. But whenever you get into fundamental metrics, the actual fundamental metrics that help them identify the companies that are value, that are income oriented, they might not be as well versed in that. And this does a lot of the heavy lifting for you. You know, you don't have to reinvent the wheel. You have a general direction as to what it is you're looking to accomplish. And then you're leaning on some of the expert screens to give you the ideas, which you can then analyze and then monitor on your own. So as we're thinking about this, once you get into the screen, obviously, you could go in and research each one of these a little bit further, diving into some of the equity summary score or some of the other fundamental research reports that are available. Anything there that you find that stands out that may be overlooked by clients in terms of the analyst research?
Yeah, absolutely. There's one area in particular that I think is just, it's kind of buried, so people don't really see it. They don't think to click into it. But I want to look at like the trend of change from a fundamental perspective over time, right? And again, I'll just use the NVIDIA example when I pull it up here. If I wanted to see how has their price to earnings ratio changed over the course of the last 5 years, for example, like it's kind of difficult for me to do that within this screen, right? Like I've got overview, I've got charts, I've got dividends and earnings, but like nowhere can I see a breakdown of PE ratio, historical PE ratios, outside of clicking into the statistics tab and then launching key statistics here, and then clicking into, at the very bottom of the page, the CompuStat company report. You can see why it's not highly clicked on, right?
We're about 4 layers deep already, Pete, right?
We're deep, man. So what this report does is it compiles for you a lot of the key statistics, not just current day, but historical. And this is a treasure trove of information, like super helpful and informative, because as we start to scroll down here, we can see, all right, what did their change in earnings look like versus the previous year as an overlay on the chart, right? And then as we go down a bit further, we can actually see, okay, fundamentally going back to 2015, how have their PE ratios changed? Because back in 2022, NVIDIA's PE ratio is 112, and the stock price has only gone up since then. But what has happened to their PE ratio? Well, if you noticed, when we were in the overview section of the site for NVIDIA, it's a 66.80, right? So that's nearly half the multiple that it was 2 years ago. Really under 2 years ago, because this is fiscal year reporting. That's why the 2024 data is not showing up here. But this is a really helpful report. Outside of this, probably the more common area that folks go to within the world of third-party research that we pay for on our clients' behalf, I would say is the equity summary score, right? Which basically is an accuracy weighted sentiment coming from the different research firms. In this case, there are 8 that report on NVIDIA, where we're saying, let's assess their accuracy, not on NVIDIA, but on all the companies they've given an opinion on in the sector that NVIDIA is a part of, tech, right? And let's see relative one to the other with these research firms, who's been more accurate over the last 2 years in the sector. And we'll standardize a higher weighting to their opinion within the overall score. So a lot of folks like to use this score, but if it's me, I'm not just looking at the score and blindly like running with the score. I would prefer to do a little bit more research to understand why these firms are giving the opinions that they're giving, meaning where does their methodology differ for giving an opinion? And then I'd actually start to dive into the reports, because a lot of folks don't understand that we also give you reports that you can dive deeper into to kind of say like, all right, in this case, let's see what Ford Equity Research thinks about NVIDIA as of April 19th. So these are some really good resources as well that I think if you're getting into that idiosyncratic, like individual stock assessment, they complement your approach of assessing fundamentals by giving you the perspective of a professional and what they would be looking at from a fundamental and beyond perspective. But if we're kind of circling back to the concept of getting a list of stocks that match a strategy, like a dividend paying strategy, there's a whole nother arena of insight and information that we provide to our clients, which is under the News and Research tab, also in the Stock Research Center, where you're basically getting into researching the research firms, right? So you can know which research firm aligns to your either framework for decision-making, strategy, whether or not you're technically based or fundamentally based within your approach. But what you would do from this Stock Research Center is you would go into research reports in this little icon just at the top left here, click into the research reports, and then you'll see a list of all of the research firms that Fidelity partners with, an overview of their methodology and their approach. So if I'm thinking, well, yeah, I use fundamentals to find a list of stocks that I might want to own for the next 2 to 5 to 10 years, I probably want to better understand the methodology and the approach and the reports that these different third-party firms are giving me, because I'm doing myself a disservice if I don't know that these exist. And if I'm looking for a list of opportunities, just as an example, a lot of these research firms actually give you model portfolios that you can kind of take and at least get some opportunities in terms of ideas that match their fundamental assessment. So just as an example here, you have, let's just go with the portfolio selector. This is a 4-page report that includes the Argus focus list. This is another one that the vast majority of our clients rarely see, because you have to kind of get into the weeds to access it, or you have to get into the alerts and subscribe to get alerted when a new report hits the wire, if you will, within Fidelity.com. But this is some phenomenal stuff, because it gives you a breakdown of why the company, Argus in this case, is giving you the perspective that they're giving. And then they're giving you focus lists, and they're also kind of highlighting investment strategies. So just some phenomenal resources here that are available, Michael. Trey, I apologize, didn't mean to stop that screen share. But yeah, what are your thoughts?
Well, so much on there. I know it's at times it can be intimidating and overwhelming, but I think if you take it in bits and pieces, that's really where you're going to really knock out all these different pieces of fundamental information and research and tools and bring it together and kind of build your own process, because for every client, it's going to be a little bit different. And some are comfortable picking individual stocks, and some might not be. Some might prefer ETFs. So like in the time we have remaining, Pete, I know there's different types of ETFs, but I know factor ETFs are something that we launched several years back, and they've become more popular. And I think they really do a lot of the heavy lifting around some of the fundamentals for clients that are looking to have targeted objectives in certain factors like value or dividends or quality. So can you speak a little bit to someone who might prefer an ETF path, how they might be able to leverage these ETFs to incorporate the fundamentals within their portfolio?
Yeah, absolutely. And you could kind of slice this in different ways, whether you're looking like at factors, say you want to get into, momentum exposure, or some
volatility is another
volatility exposure, right? So what one would do if they wanted to better understand the suite of products, if you will, that are available to them, I would say go into the products tab click into ETFs, because this gives you a really high level overview of, okay, what are some of the ETFs that exist out there? And in particular, the Fidelity ETFs, but we don't, just highlight Fidelity ETFs. You'll also notice iShares and more. But if you click into Fidelity ETFs on this page, you'll see that there are some featured ETFs, like an enhanced large cap core ETF, right? The total bond ETF. And as you get down a little bit further, you see others that are a bit more factor driven, like blue chip growth ETF, right? Magellan ETF. These are almost more like actively managed hybrids of the mutual funds, right? So there are a lot of different areas that you can go within the ETF space. As to where you might go, though, I think that's where you have to consider what is the genesis of your hypothesis to think that arena of, let's call it, clean energy is an area that I want to get exposure to. And to me, that's where, a lot of the top-down resources that we've talked about become critical. But also, if you start to get into that markets and sectors research page, there's a lot of really great info in here and great insight that helps you kind of formulate the hypothesis around fundamentals in terms of where you might go for exposure and which investment vehicle you might use. So on the markets view here, not a ton in terms of actionable insights. If we click into sectors, there's a lot in terms of actionable insights. Now, top view here is just sector performance, and then just a kind of an overview of what the business cycle approach to sector investing looks like. And then if you scroll down, you'll see the 11 sectors of the equity market. And if I wanted to dive deeper into, let's say, communication services, because when we were looking at Denise Chisholm's quarterly sector update, we saw that she was actually underweight. Well, that is kind of contrary to what CFRA and Argus think. They're both overweight in this area. So I might want to consider and dive a little bit deeper as to why there would be a conflicting viewpoint there of an underweight versus an overweight. And so in this arena, what we can do is we can learn a little bit more about the different industries that are a part of the sector, but then we can dive deeper into the fundamentals at the sector level. And you'll notice just at the top here, find investments. If I want to find an ETF that fits a specific sector, I can do that very easily as well. How about that, Michael?
You just made it easy, Pete.
There's a lot out there. Sometimes it's easy.
Yeah. The half the battle is first part of the battle is knowing what you're looking for. Second part of the battle is knowing where to go to find it on the website, because there is so much out there. And we've been named the #1 online broker the last 7-8 years running by various publications. A lot of it's driven by the depth and breadth of research that we do make available. I still feel like we're just scratching the surface today with some of the items that we've talked about. Hopefully these are tools and resources that you're already using in some capacities. If so, that just validates you're looking at the right thing. And if you're not, maybe we introduce some new areas of the website, some new ideas and concepts that you can kind of work into your own process. It definitely takes time. We say it's skill, will, and time. Those are the 3 things you need in order to be self-directed and to do it right. So if you have the skill, to have the will, you have the time, we've got the tools for you. If you don't have the skill, you can build it. So if you go to News and Research and Learn, where Pete took us earlier, this is where you could take more online webinars at the comfort of your own home, and makes it pretty simple to kind of pick up and build your skill around fundamentals, technicals, you name it. Plenty to keep you busy. Well, Pete, I know we're right at time. We got just a little break before we kick off for the 3 o'clock session. So thanks for your insight today, Pete, and thanks to everyone for taking time to join us today. If you made it this far, you've made it through 2 of the 3 sessions. You can come back for 1 more. It's the battlegrounds. This is the technicals versus fundamentals. We're putting it all together for you. We got Pete Stringfellow, John Gagliardi. He's going to be going through the technicals. We're going to try to see how we put this together, form a bigger strategy. So with that.
Oh, he's invading. He's invading already, Michael.
Oh, he's already coming in. Oh, Pete. Oh, there you go. I'm
I'm
switching.
gonna wrap my knuckles for this one.
Yeah, I'm going to be neutral.
tough thing is-
I'm just.
I agree with everything Pete said. I don't know what I'm going to say.
Oh, well, thanks for popping in, John. We'll come back to you here shortly. We'll take a quick break, be back at the top of the hour. Just want to thank everyone again. We'll look forward to reconnecting here in the near soon. Thanks, everyone. All right, everyone, welcome back. It's the 3 o'clock hour. We are starting off, actually wrapping up 3 sessions on technicals and fundamentals. And the final session, we are trying to put it all together. So my name's Michael McCrary. I'm a regional brokerage consultant for Fidelity. And along with my colleagues, John Gagliardi and Pete Stringfellow, we work with clients across the country to educate and support clients that are self-directed, helping them better understand strategy and also better leveraging the tools and research available at Fidelity to help you make these informed decisions yourself. So as we round out this 3-part series, this is a couple of quick housekeeping items that we wanted to make sure you address. If you didn't get the first 2 times, this is the 3rd time. And so if you notice on the right-hand side, there is a Q&A. So if you have questions, you can just move over to the right and type in your questions as we're going through. We'll try to address them as best we can. And there is closed captioning available. So if you wanted to turn that on at the very bottom, below the video player, you have the ability to turn on closed captioning. So Pete, John, I feel like it's the battle round a little bit. John, you stepped in early, has talked about technicals and the value of technical analysis. Pete, you came in second session, focused on fundamentals and what are some of the tools and resources and why the fundamentals are relevant. But, just kind of in each of your perspectives, how do you bring it all together using both the fundamentals and the technicals? Because, when I came up with John and we got our CMT, someone told me that was called fusion analysis, when we're bringing both fundamentals and technicals together. Is that really what they call it, John?
I don't know what you call it, but I will say that I definitely don't live in the world with blinders on that. When something's going on in the chart, one of the first things I check is what's going on with the fundamentals. Is something has happened to make the chart do something unexpected. And there's been plenty of that. We've got so many things we could talk about that's happening just this week and even today.
Yeah, I couldn't agree more on that front, John. I enjoy using fundamentals as the base for identifying opportunities across markets. But I make little to no action without assessing technicals, because in my mind, it's almost like, let me assess my fundamentals to determine which stocks I might want to own for a bit of a longer term investment strategy, right? So reallocating capital or rebalancing the portfolio to some degree. But just because I did my research today and found an opportunity today doesn't mean today is the day that I make my trade, right? And to me, that's where the technical side really comes into play for like a longer term investment strategy. It's saying, all right, I've got my opportunity. Now let me assess where are my entry points. And I say points for a reason, because rarely would I deploy, all of the capital I want into a position in one trade. Like, I'm going to scale into a position based upon the technicals over time. And I'm going to predefine what that time is based upon my parameters of how I look at charts, right? So John, I'm curious how you or Michael, how you guys might differ in that approach.
I think you just said it. I mean, fundamentals first, right? Fundamentals tell you more about the quality of the company. And then I'm going to lean on the technicals to help me better understand the timing of when to get in and when to get out. But what I always tell clients as well is kind of depends on your time horizon, right? Because the longer term investor you are, the more you're going to lean on fundamentals. Whereas if I'm a short-term trader, fundamentals are still important, but it's really the technicals that are going to prompt my entry and exit short term. So John, you got the charts up. Let's get your take here.
So I would say it cuts both ways. Like if you let's play it in reverse, because when we were coming up, we always heard, well, the fundamentals are your list of what to own, And then your chart is your list of when to own. And the chart is really more for timing. Okay, let's broaden that out. Let's talk about big picture stuff as an investor. When do I want to own stocks? I want to own them when they're going up. So I might be a lot more defensive from 2000 to 2013, but since 2013, every pullback was a buyable event. 2016, 2018, 2020, and just more recently, 2022, we were down 28% off the highs. We are in a secular long-term bull market, big picture. Intermediate term picture, if we look at the last 5 years, we spent the last 2 years correcting and backfilling that correction. And now we just broke out to new highs. We are in our first pullback of all-time highs. And if you believe there's a 5-year business cycle, and you believe that this can continue for another 3 years and 9 months, or 2 years and 9 months, if you believe that you'll get 3 years good, 2 years bad, well, this is your first pullback in a brand new bull market. This looks pretty good. Now we could say, all right, fundamentally, what makes sense? So we could kind of do it. We can do fusion in a way. But we can start with the technicals saying this is a very, very fertile territory to own stocks.
Yeah, you're not wrong by any means, John. I think it's all just a matter of how you frame it for yourself, right? And to me, over the last 20 years of working with independent clients, I know, John, you and Michael have a bit more tenure than me in this space, but between the three of us, we're probably in the 70 years of engaging with independent-minded clients. And I find that the biggest error that they make, people who want to manage their own assets, is they do not define their framework for decision-making, and they do not define the strategies that fall within the framework, nor the research process. And that, to me, is what becomes absolutely critical. Whether you're starting with fundamentals or technicals doesn't really matter. What really matters is, what is the process that you're going to use, and is it a repeatable process? Because if it's not, you're setting yourself up for basically trying to get lucky.
So you touched on that, what's the process? When you think about processes, you highlighted this a little bit in the second session, Pete, but more of a top-down approach versus a bottoms-up approach. I think that's pretty one way that you can define some of these processes. But if you think about a top-down approach, John, if you're more of a top-down investor, what might one look like from a top-down approach?
So it kind of where we started, right? We start with markets. Do I want to own stocks? Stocks are up. The answer is yes. Next thing, next order of business, I could just go buy the indexes and I don't have to manage the risk. I could buy IVV, and for 0.03%, which is nothing, I own the S&P 500. They are doing the stock picking for me through committee, and they are doing risk management through the market cap weighting. And by the way, I'll just make a quick footnote of this because this is something most people don't know and they should. If you look at the portfolio composition, everyone makes a comment, oh, it's way too heavy at the top. It's not diversified enough. It shouldn't be that the top 10 names are 32% of the S&P. This wasn't working before. Now I had it working, and let's see if here we go. We're kicking in. The top 10 names are 32% of the portfolio. Now let's talk about that. If I was creating a team and we were creating a team based on the stock market, name the 10 of the best stocks on the planet, go. You're probably going to name Apple, Microsoft, NVIDIA, Amazon, Facebook, Tesla, and yeah, Eli Lilly. They have a blockbuster drug of the century. Now they're in the top 10 of the S&P. So they're doing the risk management, but if you look at the bottom 100 names, the bottom 100 names are only about 3%. What does that mean? Well, that means when Silicon Valley Bank and First Republic Bank went bankrupt directly out of the S&P, you were down 0.02%. And did you care? No. The S&P is down 46 basis points today. Would you care if it was 48? Stick around 3 seconds. It'll be 48. Just hold your breath. It'll be 48 before you run out of breath. 2 basis points doesn't matter. And that's the genius of the S&P. That's why it's so hard to beat. It's not just the stock picking. It's the portfolio management. And that's why the S&P is so hard to beat over the long haul. And Warren Buffett, his plan, his executive plan for when he passes, sell all my stocks in my personal account and go buy the S&P 500 in the lowest cost way we can do it. And that's the plan for his estate. So if it's smart enough for Warren Buffett, if he can't be there to do the management, you may need some help in management of your own. It could start with owning the S&P or the NASDAQ if you want to get a little more aggressive. Instead of 500 names, you have 100, still market cap weighted. But this is a good place to start. Now that top-down approach, this is your beginning point. Okay, you own the indexes. You don't have to manage the risk. Now what? Well, if you're trying to beat the S&P, and Pete said this during the fundamentals, you go right here to markets and sectors and figure out, okay, which sectors are leading the way? And this is a heck of a lot easier to choose among 11 sectors than it is to choose between 10,000 stocks. And by the way, the real investable universe, stocks that trade above $10, you're down to 4,000 stocks. Still really hard to do. But there's only 11 sectors, and of the 11 sectors, you'll never go bankrupt owning a sector. Can't happen. And if you could pick the right ones for 2024, and Pete had said this, he said, this is all backward looking, 100% right. If I click my 1 year return, communication services, technicals, technology, financials, consumer discretion, the exact 4 sectors that are supposed to be the early phase of a new bull market led the way last year, past tense. Looking forward, what's coming up, nipping at the heels of the S&P? Industrials, materials, and energy, right behind. Mid to late cycle stuff, this is where the jobs are, this is where the economy expands. Know how I know we're not in a recession? If I look at the bottom, it's utilities, real estate, consumer staples, healthcare. All the recession-resistant stuff is right at the bottom for 1 year returns. If I look at 3-month returns, holy moly, sector rotation is happening. Energy up 19%? What the heck? I don't like that utilities are up. But industrials, I like that, 8%. Financials, 8%. Sign me up. This looks like the new emerging stuff. Sector rotation is not just happening. It's happening right this week as we speak. It's going on right beneath our feet.
So finding strength in the market is essentially where a top-down approach will lead you. Top-performing indices, top-performing sectors, trying to stay in the areas of the market that have the wind at their back. Pete, just expand a little bit on the bottom-up approach. I mean, I don't think it's one way's right, one way's wrong. This isn't like a competition here. It's just kind of a school of thought, and every investor kind of falls into one. If they haven't, then maybe it's kind of a blend of the two, but it helps you with your approach of blending fundamentals and technical analysis is knowing which of these camps you fall under.
Well, to some degree, you might also be considering just how much time do you have, because that might dictate the approach that you take. Like if you have less time to do research, to stay on top of what's going on across markets, economies, and so on, you might be better off, with a top-down approach. Because when you start to go down the road of bottom-up analysis, that's typically where you're really focused on individual companies, right? And you're saying, all right, macroeconomics aside, they're going to have an impact, but let's assess company-specific metrics within their financial statements and analyze their growth prospects. And from there, let's select individual stocks to build the composition of the portfolio across, say, the sector that we want to get exposure to, right? And like with what John said related to top-down strategies, a lot of top-down strategies are oriented to the sector rotation strategy, right? Where you're saying, based upon the economic analysis of where we are within any given phase, I'm going to consider the historical roadmap of what happens, but I'm going to dive deeper in to the macroeconomic and fundamental factors that might give me an indication of where I would get exposure, right? So like the concept that Buffett throws out of, passive indexing. I think it gets oversimplified a little bit too often because it neglects to consider other investment vehicles that might be more appropriate for any given strategy dependent upon asset location, right? And what I mean by that is if I have $1 million sitting in an after-tax account, it's not a qualified retirement account, it would behoove me to be educated on what separately managed accounts are compared to what ETFs are, compared to what mutual funds are. because I have the ability to get passive indexed exposure through all of those vehicles. But if I'm in a taxable account, a separately managed account has a strategy that is tax efficient investing that gives me the exposure to the index while capturing tax alpha along the way. And a lot of independent minded clients neglect to consider that the cost of that pays for itself very easily compared to getting exposure through an ETF or a mutual fund for that matter. And from there, if I'm taking this top-down approach, I'm saying, okay, this is my ballast. The ballast is my indexed exposure. That's how I'm going to make sure I have a high beta relative to my benchmark, meaning I'm really correlated to the benchmark. And from there, I'm going to build satellite positions to tilt my portfolio to the sectors of the market or even different asset classes that would give me the exposure I want based upon my hypothesis. So that's a very different kind of concept than say, I'm going to build satellite exposure by way of individual stock, because I might be able to hit a home run or a grand slam with the individual stock exposure as the satellite complementing the benchmark. But I could also strike out really easily, right? So I think that that's kind of where the difference comes from is thinking bottom up. I need to be really refined in the approach that I'm going to take, and I have to be really buttoned up in the cadence in which I'm going to make decisions and the sequence in which I'm going to do research to make those decisions. So I think to me, that's where, the rubber kind of hits the road on top down versus bottom up. Personally, I run both, right? Like I break out my assets into 4 different paradigms and I say, okay, the short-term paradigm is my cash management strategy. The long-term is my strategic paradigm where I'm doing just this. I'm saying, yep, let me get a lot of exposure to my benchmark, and I'm going to run a sector rotation type strategy. But then in the other 2 paradigms, I'm going to say this one's tactical based upon what I need in my portfolio, based on my life. And I should have a plan in place to help me, determine what to do in that arena. And then I might also have a speculative paradigm. That's what I do, where, I'm probably playing some moonshot opportunities as opposed to trying to, manage the overall core satellite strategy within a portfolio.
So can I
any
play devil's
shot
advocate?
recommendations there, Pete?
I have a lot of them.
Go ahead, John.
So I'm going to play devil's advocate and how you could utilize a couple of things that Fidelity does offer. So first, you can go buy the ETF, right? We could always go buy XLI, and I've got all these industrial names in market cap weighted, and they're all S&P names. They're all high quality names. But if you look through the list, right? GE, can't believe I'm going to say this, but love it. Cat, love it. Uber, love it. Going through the names, Boeing. I've seen that chart. Don't love it. Eaton, love it. So what can I do? What are our alternatives? You don't have to just buy individual stocks. You can use Fidelity Go and create a portfolio. Okay, of these top 10 names, which 7 do I like the best? You can create a portfolio around that. So take advantage of some of these things that Fidelity has, because we offer them. And I say this with love and affection. We're like the Costco Financial Services. You're going to get a ton of research and all sorts of programs for free, and take advantage of them, either very low cost or free. But when you look at the charts, this is a 5-year chart. GE breaking all-time highs. How do you not love it? Caterpillar breaking all-time highs. Nasty little pullback there, but still looks good from a chart perspective. Long term, it's in the right direction. Eaton, one of the largest providers of electricity and wiring. So if you think that they're going to wire AI and not need these guys, you're much mistaken. You don't need them quite as much as NVIDIA, but you still need to wire this stuff. And Eaton is a huge beneficiary of what's happening in AI. And what I don't love, there's plenty of things in that list. This is not a chart that looks like it's going up. And whenever you see this kind of gap down, run down in price, big spike in volume, that's the direction it wants to go in. And yes, there was follow through. When you see this, I don't ask why, I run for the hills. And that, I think we're starting to talk a bit about risk management. And Pete, what do you think of Facebook's earnings? And again, I hit the wrong letters again. Meta.
Yeah. So as a long time, owner, investor in Meta and Facebook when it IPO'd, I was extremely happy to see the initial news line on earnings. And then I saw the impact to the after hours market yesterday, and I thought, oh, this is one of those interesting dichotomies where it's not just about the earnings in the current state. It is about the perception of the future earnings and the future growth based upon what was tacked onto the earnings call, along with other, of course, elements of analysis that the different research firms conduct that would then feed into, institutional decisions of what to own or what not to own. But yeah, like the earnings beat was phenomenal. Now, do I think
471 versus 432 expected? It's a 39-cent beat. That's approximately a 10% beat on the expected earnings. 10% beat, and they punished the stock with a 10% earnings beat. Revenue beat, everything beat. Top line, bottom line, cash flow, you name it.
So what I would start to ask myself from a fundamental narrative perspective is, did the valuations run too hot over the course of the last year? And that is why, even though we're beating the earnings in this most recent report, the expectations for future beats, right, is decreasing in probability. And so then you have a lot of people in the market as investors who are thinking, well, I want to reallocate to a different position, perhaps in the same sector, that has more potential for growth over the next 3 to 5 years than what I'm seeing based upon, Zuckerberg's commentary during the earnings call. So that, I think, is where a lot of folks get hung up, is they think, but wait, the earnings are this. And so the earnings should move the price. But it's the perception of not just the current state of earnings or the prior state of earnings, but the future state of earnings and revenue growth and operating income and so on that have a bigger impact on the perception of whether or not to hold or sell.
Okay, so this is an interesting, so we've got earnings, we've got fundamentals. The thing that's in the middle is the multiple. So the things that always throws me about fundamentals, that makes me insane, and you could see it in the numbers, right? If I go to the PE ratio, if I get a quote here, it's what are people willing to pay for future growth? So if the S&P has a PE ratio of, let's say, 21, and the PE ratio for this is 28, it says, okay, I'm willing to pay about 40% more to own Meta rather than owning the S&P, with the idea that it's going to beat earnings. Its valuation is going to go up 40% faster based on the fundamentals. That's the fundamental argument. Now, to me, the long-term investor is waiting for this pullback so they could add more, and they've just been patiently waiting. Maybe if they saw how far we were from the 200-day moving average, maybe you sold some. Maybe you were lucky and you got out of some at the high. There are some warning signs on the chart. So let's talk about warning signs. The first thing, and I got to switch to my 5-year because I don't want to give information that I feel isn't really great. Now, when you see higher highs on price, which we had multiple higher highs on price here on the weekly, and you notice my highs on relative strength are getting equal and then weaker and weaker, don't take that as, oh, well, earnings are coming out, all this stuff's going to happen. There's always going to be earnings. There's always going to be fundamentals. There's always going to be news. Take it at its word. This thing is overbought and the buyers are getting weaker and the sellers are starting to pick up some momentum. And if you zoom in on the chart, because sometimes you have to zoom in too. I always say when in doubt, zoom out. But if you notice, my highs aren't real convincing. My highs aren't super higher than last. This is really a big sideways move. And it turned out it was a peak. We gapped down. We're getting a rally. We're getting a nice bounce, but the damage is huge. So if you're more short-term oriented, nothing wrong with a rebalance. That's all this is. It's a rebalance. The things that are gapping down and collapsing on earnings, you could always unwind some. Don't worry. The train's never late. On the other side of the tracks is another train coming in. Here's earnings up 4% on the day. 5%, sorry. We're 5% on the day on URI. And if you look at a lot of the home builder stuff, they already had a nice pullback. They did a nice 10% pullback. There's always an opportunity where you could rebalance again. But when I see that gap down, I did it again. By the way, how many people did come up? Trey, how many people came up and said they hate the new symbol Meta and they still type in Facebook? I must do it like multiple times a day. when I see this gap down, and I'm going to guess this happened on big volume. Ooh, yeah, we're getting close to 80 million shares on the day. That's an institutional exit. I appreciate the rally. If I could sell some at a higher price, I'd gladly. But this spooks the heck out of me. And this is where I will disagree with Pete and anybody else out there. Technicals lead, fundamentals lag. And what am I talking about? Facebook had fantastic earnings and it fell apart. And if you think this is the first time, it is not. I'll give you a great historical one that I love to show people. This is US Steel, the #1 stock to own in 2007. The only reason I will forever remember this, I actually had a client who said he invested 2/3 of his life savings in this, and he was already down 20% off the highs. And he called and he was crying on the phone, an adult man crying on the phone, saying, what do I do? What do I do? And we don't say buy, sell, or hold. We don't have an opinion. He said the earnings were going to come out and the earnings were going to be fantastic. And all I kept saying, well, what is your plan? What if the earnings collapse? If you notice, the stock goes from $20 a share to $200 on the way up, $3.50, 71 cents. That's a goof, 80 something cents, $2, $3, $3, $2, $2, $2, $3, $2. There was a 29-cent, 1-cent charge, one-time charge, $2, and the stock keeps going higher. At the peak here, it earns $5.65. Fundamentals are in place. The stock goes into collapse mode, and by October, they give the best earnings they've ever had, $7.79. My opinion, the stock market is a leading economic indicator. The smart forces at work are in a year ahead of time, and they're out maybe a year ahead of time, maybe less. But generally, the Warren Buffetts of the world, they keep the meat of the move. They never get out at the high. They never buy the low. They're looking for the middle of this when the stock is outperforming, and maybe the earnings aren't quite there yet, but the expectation of next year. So this client said, you'll see the earnings are going to come out. They're going to beat the street. They're going to win. And by the way, the reason he bought the stock was everyone on CNBC said it was a no-brainer to own the stock. So his last quote was, the stock isn't going to go to 120. He decided, I'm going to put a 120 stop. Stock was trading in the 150s. Not only did it go to 120, it just went to 20. Forget the 100. It lost $100. It just went straight to 20. And by the way, the earnings after that, back to 250. And then finally, 9 months later, they put in a loss of $3.78. So if you were waiting for the fundamentals, you waited way too long. As soon as you see that trend break, you don't ask why. You head for the hills. You see a gap down, run down a price, big spike in volume. There's no reason not to sell some. There's no reason not to sell this on the way down before this all happens.
John, you just kind of hit the questions that have been coming in on a couple of items, but a couple of the questions were like, what might one do when fundamentals and technicals are in disagreement? And also, like, what are the best leading indicators for buy and sell signals? And if I'm just hearing you correctly, what you're saying is it's price action. Like, pay attention to price. Price will reflect what's taking place, and focus on price first. Fundamentals will follow at some point, right?
Price is what pays you. Fundamentals don't pay you. Price pays you. So this is AIG, another great example. All positive earnings and splits on the way up. As soon as the trend breaks, sell some. There's no reason to own more of this. The stock market hit an all-time high in 2007. This was still down 40% from its highs. No reason to own this. It's not outperforming the market. It's not outperforming anything. And once this happens, once it's not going up, it's not going sideways. It is, in fact, going down. Not a opinion. It's a fact. When that happens, you just sell it all. It doesn't make sense to own this through the downtrend. And by the way, this is 50 years here of AIG. This is not a short-term view. This is a long-term view. And by the way, if you think things come back, this has never come back. We're still trading at $74 a share. That's with a reverse split of 1 for 20. So the actual price, based on the old AIG pricing, that would be $3.80. $3.80. A 1 for 20 reverse.
Really important though here, John, that we bring this all together, right? Because if we're living in this like a silo of, well, yeah, technicals are leading indicators of like what the future might hold. Fundamentals are historical. I don't disagree with that, but deciphering what the technicals are telling you is very similar to reading tea leaves, right? And saying, well, here's what the future might hold based upon the past price action movement that we've seen and the patterns that we've seen with this type of price action. It's not a holy grail, right? That's my point there.
Pete coming in with the jabs from the fundamental side, and I think you bring up a good point, because we hear it often. We have clients that we run into, and that they're a little more skeptical on technical analysis. And hey, you're just reading tea leaves, and it's voodoo lines on a chart. And so, I guess for me, and I don't know what y'all think about this, but I think it's important. I have to respect their views on that. They absolutely have their point to that view and their stance. But what they also have to remind them is that there is still a large population of investors out there and institutions out there that do incorporate technical analysis into their strategy. So even if you don't believe it, you have to respect that others do, and others are using it in some way, shape, or form to be part of their decision making. So you're better off, rather than just neglecting it altogether, you're better off having some awareness of what might be driving the technical side, as opposed to just dismissing it altogether.
I couldn't agree more with you there, McCrary, because you mentioned fusion analysis. I think that was probably an AI hallucination, but to me, like when you marry technical and fundamental analysis together, that is called security analysis. You're actually analyzing the security, and you're not just looking at one or the other. You're using them as a complement to one another. You're probably also looking at, like, what kind of short shares are there outstanding with these positions, because I can infer a lot from that in terms of expectations, especially from institutions, but also retail investors. That would help me make the decision. But I think what I was trying to make as far as a point wasn't to, like, knock on technicals, because I use technicals daily. But I was making that point because it is critical that why you own a stock. Why you own it and what your expectation is for it. You don't just blindly or nebulously collect securities, right? But rather you have a framework. You've defined your process, you've defined your strategy, and how you go about making decisions. So if you're John Gagliardi, you can go in there and you can say, oh, we just broke down below support with a gap down, and we have decreasing RSI and MACD. Like, I am out of this position, even though I bought it for the long haul because I believed in the underlying business, right? So not only should we be looking at fundamentals or technicals, but we got to look at the underlying business. I think NVIDIA is a great example of this, right? Phenomenal technicals, phenomenal fundamentals. But 10 years ago, if we're looking at NVIDIA, like, where's our head at with them? Well, it's probably like, where's their growth going to come from? Even 5 years ago, or 3 or 2 years ago, where's their growth going to come from? Because they can only sell so many GPUs to gaming companies that are going to take these GPUs and really put them into the market through, this client base of people who like to game or people who like to develop content, right? But enter in a new or nascent industry, in the case of AI, more so like a nascent technology. Okay, well, now there's a whole nother use case for GPUs. Boom, sales take off. You're not going to read into that through technicals or fundamentals, but your technicals are going to be the leading indicator as to the breakout, right?
So this is a great combination of the two, right? The chart was always in agreement. It's going up. And the fundamentals have definitely gotten there, right? We've gone from like $1 and change a quarter to the 2s to the 4s, right to 5. And these numbers, by the way, the analysts were really jumping the numbers higher, and they felt like, oh, it's impossible. I've set these expectations so high, they can't beat. And sure enough, they beat. They beat pretty heavy-handedly. And they come on the conference call with massive confidence about how they're going to continue to beat. Now, that all being said, we got a little ahead of ourselves here, right? And the stock pulled back very, and I said this in the first session, you had a 200-point pullback. You know how many clients I've heard say, oh, if this would only pull back. there was a 200-point pullback, and now everyone's scared to death. Well, what if it's 300? What if it's 400? And there's no right or wrong answer. Because there's no right or wrong answer, you're dealing with something that's impossible to predict and completely, sometimes feeling almost random. So we know we do have a trend in place. We are in one of the biggest leaders in the planet. You could always buy some. You could always take a small position. You could always expand it. One thing that you will notice psychologically by having it on the board and owning it, now you have some skin in the game. For win or for loss, it doesn't matter. It's now you have the skin in the game and you really know what's going on. You're going to pay a lot more attention by having it. There's some positions I have one share of that I just have there just to know what's going on with that asset class. So this is a great agreement. Let's talk about another disagreement.
This is awesome. Hey, John, can I throw a curveball real quick?
Yeah, sure.
I want to throw a curveball because I want to kind of highlight for folks how they can put this together through Fidelity.com. I'm going to actually jump into here a stock screener. All right. And I don't have any criteria added to the screen yet because I'm going to use one of the pre-built strategies just for the sake of time. Okay. So I've clicked into strategies. I've clicked into growth for these strategies. Keep in mind, this is from the news and research tab, clicking into stocks, clicking into screening tools at the top left. Okay. I want to use earnings growth, rating upgrades, and positive surprises as the example for our strategy. If I click into this strategy, you can see that there are 0 matches to this strategy. And it's all because of the 30-day analyst consensus. There have been no positive changes here. So the 53 stocks that come through based upon the EPS metrics, the forward EPS, the EPS growth, there are 53 companies, but there are no positive change earnings surprise or earnings surprises for these companies. So like I can take this criteria out if I want to, right? I can just say, well, were there any positive earnings surprises? Take out the change from the analysts. And in this case, yes, there were. All right. So why does that matter? Well, because the analysts are not upgrading these companies over the course of the last 30 days. But to John's point, well, what if we want to look at the technicals for this list of 34 companies? Keep in mind, like I've never looked at this list before, right? I'm looking at the list and I'm thinking, okay, I know some of these names, but if I'm thinking through like, all right, technicals as being a potential leading indicator of what position I might want to dive deeper into from a research perspective, I have the ability to manipulate this screen. Right? Like you noticed I removed one of the criteria. This was a pre-built screen. I removed the criteria. I have results now. I can also now come in here and say, I'm not interested in the most popular criteria on the left-hand side, but I'm actually interested in the technicals right here at the bottom. Okay. I can expand technicals and I can say, oh, percentage of price off of the moving average, just what John was drawing in to the chart, basically. I can incorporate this into the screen. Or
I like 10% within 52-week highs.
You like what?
Anything 10% within 52-week highs, because that's what the market's done.
Right, exactly. But let me throw a different curveball at you. Like, I'm just going to say, hey, I want to know whether or not there's been any classic pattern technical event that's happened on one of these 34 stocks over the course of the last 30 days. Because, you know, there were no analyst upgrades over the last 30 days. Were there any technical indicators that are indicating a breakout in price for these stocks? Because that might be a leading element that I could look at to identify a list of stocks that I might start to ease into. So I'm going to come in here and say within the last 30 days, what have been the bullish technical events that have occurred? I'm basically going to say, just show me the companies that have had those bullish technical events. There are 5, right? There are 14 bearish technical events. And the 5 that were bullish came through what? Chipotle, Insulet, Chipotle Group. I think you mentioned that during your home builder comment earlier, John, in the first session. And I can scroll off to the right and I can simply say, okay, well, what were they? Right? What were these classic patterns?
Use Ralph Lauren. You won't believe the chart when you see the chart on Ralph Lauren. Look at the last 5 years of Ralph Lauren. The chart's gone gangbusters and hasn't done anything in a decade.
Well, check this out. I mean, there's a continuation wedge that went live on the 19th. So to your point, like if I want to just jump into Ralph Lauren here, I can click right into the link takes me into the research dashboard for that stock. And now I can dive in a little bit deeper. I can either say, all right, let me just briefly take a quick look at the sentiment from a fundamental perspective and a technical perspective. Valuations, okay, look pretty good. You know, technicals, looks like midterm were low. That might mean there's a potential entry point here if I'm trying to ease into a position or maybe even play a swing trade. So from there, what I could do is I could say, let's look at that chart plus and let's actually see where the event occurred. So like, John, I know you've been using Active Trader Pro. I like to use Active Trader Pro, but if I'm doing quick hit like assessment and trying to find opportunities, I usually just do it within fidelity.com here. So I can come in and simply say, all right, you know, obviously we've got, you know, the trend. I'll go back to this 10-year, John, like you asked, because yeah, they've gone gangbusters here in the last few years, right? If I now say, let's look at the 2-year, and I actually want to bring in different events that have occurred, I want to see these classic pattern events that are on the chart. And what the tool does for me is it actually shows me all of the classic pattern events that are on the chart. Now, I have to make sure I'm on the right frequency because right now I'm on a weekly frequency, and the event that occurred is a daily frequency event. So I'm going to go to a 1-year instead of that 2-year, and I'm just going to toggle back over to a daily frequency instead of a weekly. And now do you see these little icons that are an arrow, downward arrow, and an upward arrow? Okay, so there was actually a double top indicated within the chart here that occurred just about, what, 20 days ago, 3 weeks ago or so?
You just saved me a lot of drawing. That was good.
But now it's pretty beautiful, right? Like, as you learn how to use these tools, you can easily marry technical analysis and fundamental analysis together for security analysis. And to me, like that is one of the best things that Fidelity provides for its clients is the ability to be really dynamic and define exactly how you're going to use the tools to do assessments. But yeah, if I'm looking at this and I'm thinking, well, geez, you know, maybe I do want a little bit of exposure to Ralph Lauren and get that exposure to the consumer discretionary sector in an individual stock or idiosyncratic way, like I can do that. But I'd probably want to dive in a little bit deeper and say, okay, like, you know, statistically speaking, where does this fall? Where does this company fall versus the industry or versus the sector? Okay, relatively under valued from a PE ratio on the trailing 12-month and on the 5-year. So even though it's had a big run up, like, does this technical that popped up in the screen give me some indication that maybe I consider a play here, right? But keep in mind, that's also where you really have to have a refined process for portfolio analysis to determine your composition of the portfolio before just haphazardly making decisions around all these different stocks, right? So that you don't overweight unintentionally certain areas of the market that may not be poised or primed for opportunity. John, I'm curious your thoughts. Michael, you as well.
I was just saying really quick while you're here, Pete, because the question came in, and I think it's timely while we're talking about this, the equity summary score, how much of that's fundamentals and technicals, right? So, I mean, do you want to clarify that for everyone?
Yeah, sorry, John, I just poached your share
no
again. So yeah, absolutely happy to. It's a little bit of a combo, okay? Because it's not a direct assessment of fundamentals or technicals, meaning the equity summary score. What the equity summary score is doing is it is looking at these 8 different research firms that Fidelity partners with. It's ranking them based on their accuracy over the last 2 years in this sector, and then it's assessing their opinions and assigning a higher weight to the overall score to those who have a higher relative accuracy score to the others, and underweighting those who have a lower relative accuracy score. So to the question of, well, how much is fundamental versus how much is technical, depends on the methodology from each of these research firms, because they all have differing methodologies. For example, Trading Central, purely technical. There is no fundamental factor whatsoever that Trading Central incorporates into their methodology, right? McLean Capital Management, largely fundamental and largely value-based. Same with Jefferson, right? How do I know that? Well, because I have this weird habit of staying up late and reading things on Fidelity.com when I should probably go to bed. But when you go into the news and research tab, click into stocks on the left-hand side, I kind of highlighted this in the last session. On the left-hand side at the top, there's a little icon. And when you hover over it, it reads research reports. When you click into research reports, that gives you the ability to assess the methodology for these various research firms who are ultimately feeding the score that is the equity summary score. So if you want to have a better idea as to how much is technical versus how much is fundamental and in bleeding into that score, well, one, it's going to depend on the sector because different research firms have different accuracy weightings within the sectors. So what I mean by that is, let's just use an arbitrary example. If within consumer discretionary, in this Ralph Lauren space, if Argus, and I don't even remember which company was.
Ford was number one.
Which one was it?
Ford.
It was Ford Equity? Okay. So let's just say Ford Equity Research is number one in consumer discretionary. Okay. They run a quantitative model-driven methodology, meaning they don't have analysts, boots on the ground, assessing things. They have built a model that is quantitative. It's data-driven model based on historical data, largely fundamental, valuation, growth, and so on, that is specific to stocks, individual stocks, right? John, do you remember what the lower one was?
At the bottom was Trading Central or close to it. It wasn't the bottom, but it was in there.
They're pretty low. So like in the case of consumer discretionary as a sector, there's a higher weight to fundamentals in that score than there is to technicals. But if we were to look at, and I'm just going to throw out an arbitrary example because I don't have it up and I don't want to necessarily confuse people by clicking through this right now, but let's just pretend Trading Central is the top performing research firm in the tech space, okay? If they're the top performing research firm based on this accuracy weighted methodology of looking at the last 2 years and call it Ford Equity is down at the bottom, then in that sector, there's going to be a higher tilt toward technicals than fundamentals. Guys, did I explain that in a way that's like digestible?
Makes perfect sense. I mean, it's a lot to digest, but it definitely gives the high points for sure. John, what you got?
I want to copy off the smart kid. Like if the smart kid is fundamental, technical, I don't care. As long as he's smart, I'm going to follow him into Nirvana here with a good position. And the kid that's getting like the 55, like I think Trading Central at a 55 out of 100, I'm going to do the opposite of what that kid, well, that kid's 50-50. It could go either way. He could be right, it could be wrong. But absolutely, I want to take the best analyst out there. And I don't care what their methodology is, but those are the ones to follow, are the ones that are getting it right. Hey, I wanted to leave on a kind of a high note and another quagmire of something interesting that people, I always notice anomalies. So I'm going to share another anomaly with you guys to kind of leave us off on a high note. So what do we know about Eli Lilly? Well, they got Zepbound, which is a blockbuster drug of the century that probably the majority of Americans would want to take. Even if they don't take it, they would want to if they could, right? It changes the way you think about food and it makes you lose weight. And all kinds of people are saying, oh, I noticed my friend lost 20 pounds and they didn't get a surgery. This is very often in today's world, this is what we're seeing. The fundamentals aren't there yet. So, whoa, the stock has gone from 200 to 800 and no fundamentals? Yeah. And this is one of those leading things, but instead of it being a cautionary tale, let's take a look at the earnings. If I look at the earnings here for Eli Lilly, it's not real impressive. It's really just been a lot of the same, and they are massively investing in the business. So you got a one-time charge here, so you can't look at that last quarter. But if you blow this up and let's say look at a bunch of quarters, it's remarkably unremarkable, right? They're kind of stuck in this $2 to $3 range, but yet the stock has gone from the lower left to the upper right in spectacular, like seven-bagger fashion, right? 700% on your money. The fundamentals really haven't budged that much yet. And the reason why? They really haven't had the drug out a long time. They have no idea what the earnings results are yet on this. What we do know is they're so desperate to make the drug, they're buying out other companies just for the manufacturing facilities. They don't care. They don't care about their pipeline. They don't care about their executives. All they want is the manufacturing capacity because they know they've got a hit on their hands. Now, will that mean that the stock will continue to go up? And to Pete's point, has the stock overplayed its hand? Are we paying too high of a multiple? And that's where the fundamentals come back in, because we have to circle back and say, based on the PE and the fact that the earnings aren't there yet, and there's no sure thing. Let's be clear of that. There are plenty of companies that have boggled blockbuster drugs. I could show you charts that look, I mean, that's a devastating looking chart from 500 down to 220 in a matter of a year. And this is just fumbling a fantastic blockbuster drug, just made every bad decision possible by management. So none of this stuff, the drug business is a tough business, heavily regulated, lots of things to go through, lots of hurdles to jump. But the chart right now is up and to the right, even though the earnings are not there yet. Expectation is now the earnings have to follow to keep this multiple and to keep this kind of valuation going and to have even higher highs. The earnings really do have to come through at some point. We've got to start seeing some big, we've got to go from the 2s into the 4s into the 8s pretty quick to justify the kind of run this has had.
Yeah, especially where the multiple, I think right now is what, like 120 on a PE perspective. But again, this argues the point of you need to know the business that you are investing in. You don't just focus on data points like fundamentals or cool drawings like John's on technicals, right? What is our PE here? Yeah, 126. So yeah, to your point, if we aren't closing the gap on that PE in an industry that typically has quite a bit lower PE, especially as an average across all the companies, well, then it's going to come in the form of a price decrease, right? At some point. Michael, what other questions in our last waning minutes here?
By the way, Novo Nordisk is in the same business with a similar drug. PE is a 45. Yep. So it really does speak to those fundamentals are hugely different.
So I think we've covered a good bit. There's a lot of questions regarding some of the screeners and filters. So Pete, you did a great job on the website going through the screener. John, what about Active Trader Pro? I know we've got some filters there in Active Trader Pro. So if someone's kind of leaning more technicals first and then fundamentals, how might you find some trade setups using the filters in Active Trader Pro and then cross-reference with maybe equity summary score or other fundamental?
Sure. So for that, I like to go to quote and watch list. I'll put up the filter window and I'll do a filter that is not very obvious. I like to go to the 52-week highs. Now,
a good bit. There's a lot of questions regarding some of the screeners and filters. So Pete, you did a great job on the website going through the screener. John, what about Active Trader Pro? I know we've got some filters there in Active Trader Pro. So if someone's kind of leaning more technicals first and then fundamentals, how might you find some trade setups using the filters in Active Trader Pro and then cross-reference with maybe equity summary score or other fundamental?
Sure. So for that, I like to go to quote and watch list. I'll put up the filter window and I'll do a filter that is not very obvious. I like to go to the 52-week highs. Now, the first thing you're going to say mentally is, well, if it's already at a 52-week high, I probably missed it. And you have to ask yourself, and Pete mentioned this, what's your time frame? Are you a short-term trader or are you an investor? Because I really don't care about the last year. I care about the next 2 to 3 years. So I'll go through this list. I like my 5-year weekly chart. What I'm looking for is something that's gone sideways a long time. Everyone's forgotten about it. Nobody cares about it. And then it just starts to go up. So when this initially broke that 2,300, that would be the interesting moment and that little pullback. So this one's a little far and ahead, but you can quickly go through this list and you will find all kinds of names in here that you would never expect. Like, would you expect airlines to be breaking 1-year highs? Perfect. Big giant sideways chart just needs to get above 50 to really start cooking. And same thing, you could, if that's something that's interesting, let's look across the space. There's United Airlines. Now, this doesn't look like a big move on my weekly chart. This was the best performing stock in the S&P last week. And it's because of this move from 40 to 50 in no time flat on good earnings. And same kind of pattern, right? We're looking for something that has been going nowhere for a long period of time, and it's just starting to show new life. It's that 5-year business cycle. And eventually, airlines will get their turn. Since COVID, we've got a 0. It's got to get above 60 to really be interesting, but we're getting there quick. From 40 to 50 in 2 weeks, that's a pretty fast move. And this is where you could kind of begin ideas and say, all right, now the fundamentals have completely changed on earnings. What else do I know about the company? And you could start doing your research. So you can do it both ways, where you start with a fundamental list and look for timing in the charts, or you could start with, hey, something's going on with this chart. Let me check the fundamentals to see, is there any meat on that bone? Is there something more to this? Or is this just, this is just a flash in the pan and it doesn't have legs? There's no right or wrong. Just develop a process, create some rules, stick to the rules.
Amen.
I can't stress enough, manage risk effectively. That way you're not letting those small losses turn into big losses. You're staying in the game to fight another round. Gentlemen, it has been a very strong, heated, contentious debate back and forth here. But reality is we weren't debating. This isn't about fundamentals versus technicals. It's bringing them both together and how you can incorporate them both. And I think you did a fine job of putting it all together for us. So John, Pete, thanks for your time today. Thanks for the insight. Always helpful. And for those of you joining us online, thanks for making time out of your day. Whether you attended one session or all 3 sessions, we hope it was worth your time. You're going to get an email afterwards that's going to link you to a number of other resources that you could use from Fidelity.com to expand on some of the topics that we discussed here today, and also build on further areas that might be important to help you make more informed decisions. And if there is someone interested in meeting with someone like myself or John or Pete in your local markets, just reach out to your local financial advisor. They'll be able to coordinate a time and meeting, whether it's virtual or in the branch. We'll be able to make that happen for you. And if you're prefer just more online, we have a strategy desk that's available at the 800 number that works through our trading teams. And they also go into great detail with technical analysis and helping you better leverage the tools and resources there. So we hope you found today valuable. Hope to see you again at one of the next month's session. And we'll play somebody else will be host next time. How about that? But it'll be Pete, it'll be John. But I appreciate y'all inviting me in today and being part of this monthly session for fundamentals and technicals. Hope you all have a great afternoon. And
wait, I promised you guys a joke. Don't you want to hear the joke?
Oh, no.
Oh, no, not again, not again.
So wait, I'm going to give you guys a joke. So a fundamental analyst and a technical analyst go out to dinner. They're at a nice steak restaurant. The restaurant, the waiter's walking over with these really nice steak knives, and he trips, and the knives go up in the air. And the fundamental analysis analyst tries to grab the knife, and it stabs his hand, it stabs his leg, and it lands right in his foot, and he's screaming. And he looks at the technical analyst, and his knife falls. He just moves his chair a little bit, and it falls right through the ground. And he says, "Why didn't you catch your knife?" And he says, "Oh, I don't catch falling knives." So that's my joke of fundamental versus technical analysis.
Good stuff. Michael, thank you, sir. John, great time.
Yeah, with that, we'll call it a wrap. Thanks, everyone. Have a great afternoon.
Thanks, guys. Have a great day.